Without objection, the chair is authorized to declare a recess of the committee at any time. Before I begin, I want to welcome members to our first full committee hearing this Congress that has been held in a hybrid format. As I mentioned last week, at last week's markup, I appreciate all members' patience these past months, and I am proud of the work we have been able to achieve as a committee in the midst of this pandemic. Members will note that today we are joined in person by 3 witnesses, while 2 of our witnesses will be testifying virtually. The screen showing the virtual platform in the hearing room has been formatted to ensure that the witnesses participating virtually appear at the top of the screen. I appreciate members' flexibility and look forward to being fully in person in the coming weeks. As a reminder, I ask all members participating remotely to keep themselves muted and when they are not being recognized. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are also reminded that they may only participate in one remote proceeding at a time. If you are participating remotely today, please keep your camera on, and if you choose to attend a different remote proceeding, please turn your camera off. Today, this committee convenes for a hearing entitled "A Biased, Broken System, Examining Proposals to Overhaul Credit Reporting to Achieve Equity." I now recognize myself for 5 minutes to give an opening statement. As the title of this hearing indicates, our current credit reporting system is broken. Good credit is a gateway to wealth. Yet, for far too long, our credit reporting system has kept people of color and low-income persons from access to capital to start a small business, access to mortgage loans to become homeowners, and access to credit to meet financial emergencies. That's why even before the pandemic, the House passed 2 bills out of this committee, the Comprehensive Credit Act and the Protecting Your Credit Score Act, that provide long overdue reforms to our credit reporting system. We are considering those bills again with this hearing. But allow me to also explain how the pandemic has exposed just how broken our credit reporting system is. Last week, I received a letter from a gentleman in Ohio. In this letter, he explained how he had lost his job because of the pandemic. Without his salary and with no help from any of his creditors, he couldn't afford to cover all of his bills. Though he had never before missed a credit card payment, his credit score has suffered so badly, he wrote, and I quote, "I couldn't get credit now if I paid someone to give me credit," quote unquote. He closed his letter by asking that what this committee was doing to protect consumers like him. As chairwoman of the Financial Services Committee, it is indeed a priority of mine to protect consumers like him who are unfairly penalized in their credit reports, and is precisely why we're holding this hearing today, to ensure greater transparency, accountability, and protections for customers and consumers across the country. We saw this coming. That's why Democrats worked to include strong credit reporting protections in the HEROES Act and other COVID legislation that Republicans rejected. This issue is not a matter of personal failings. This is about a failed system. This is a system that fails people with credit, perfect credit, who may be victims of identity theft. This is a system that fails people who get caught in a debt trap because of predatory lending. And this is a system that fails people who don't have the means to dispute errors that reporting agencies make. As further proof of the need for reforms, in a ruling issued last Friday, the Supreme Court denied relief for thousands of consumers who Transunion wrongly matched with the names of those on a terrorist watch list. The credit bureaus can now label Americans as terrorists with impunity. The Consumer Financial Protection Bureau's complaints about credit reporting surged 50% in 2020, receiving nearly 50,000 complaints in December alone. During this campaign, President Biden supported a proposal for a public credit reporting agency, and I directed staff to prepare the discussion draft we're discussing today. As some of today's witnesses will attest, creating a consumer-oriented public credit reporting agency would be a major upgrade over today's broken, biased credit reporting system. We need big, bold legislative solutions to transform this broken system. So I encourage my colleagues to join me in reevaluating how we determine credit worthiness and learning how we can harness new technologies to build a fairer and equitable credit system. So I yield back the remainder of my time, and I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Thank you, Madam Chair. We can all agree the credit reporting industry is in need of reform. While there are thousands of companies across the country that operate within the credit reporting system, there are only 3 nationwide credit reporting agencies. It's clear it's an oligopoly. That means there is less consumer choice and competition to provide the best product. Reforms are certainly needed to improve this system for all participants. For example, we should be working together to eliminate barriers to entry in this industry. We should be thinking through ways to encourage more companies to compete with the 3 credit reporting agencies. But instead of creating more competition in the private sector, my colleagues on the left go to the same playbook: a government-run bureau based on anecdotal evidence, faulty data, including slanted surveys. This is part of their broader goal to dismantle the financial system as we know it. If the idea of a government-run credit reporting agency isn't bad enough, the Democrats want to house it at the Consumer Financial Protection Bureau. This would be disastrous. We should be promoting competition to create better opportunities for consumers, not allowing a single government entity to run the credit reporting process for all Americans. We know the government-run programs are the least effective entities to deliver services. Can you imagine the IRS, the post office, the DMV compiling and maintaining your credit report? It may not be great now, but holy cow, that would be awful. Additionally, we know cyber attacks are on the rise. Personal financial data is some of the most coveted information by criminals. Add this to the fact that Democrats consistently want consumers to use their full Social Security number to identify themselves. It's a recipe for disaster and more identity theft. A massive new government-run database of consumers' personal financial information would be a sitting duck for bad actors. Finally, a government-run credit bureau raises privacy concerns. The government should not be the central repository for all financial data available on its citizens. That is a very dangerous precedent. As my fellow Gastonian from North Carolina, nice small town in western North Carolina, Thomas Sewell grew up in my hometown, and he stated, "It's hard to imagine a more stupid or more dangerous way of making decisions than by putting those decisions in the hands of the people who pay no price for being wrong." I agree. It is a terrible idea to give the government the power to make credit allocation decisions, potentially based on political favorability. We've seen the IRS target conservative groups. We've seen federal regulators pressure financial institutions to divest of whole industries. Why would we take the risk with individual consumers' information? Our free market system is the envy of the world. Our choices are better than anywhere else on the globe. It encourages competition that benefits consumers by yielding solutions that better serve them. There is room for improvement. Yes, that is indeed the case, but not with government takeovers like what my Democrat colleagues are pushing today. And with that, I'd ask unanimous consent to insert 2 letters into the record expressing concern and opposition to the bills attached to this hearing today, including one from the Consumer Bankers Association and another from ACA expressing concerns with attempts to alter the credit reporting market, including government-run bureaus.
Without objection, such is the order.
And I yield back.
The gentleman yields back. Thank you, Ranking Member McHenry. I now recognize the gentleman from Missouri, Mr. Lukemeyer, for 1 minute.
Thank you, Madam Chair. This hearing marks yet another step taken by the majority to move toward a socialist financial services industry. Attached to this hearing is legislation that would create a government-run credit bureau within the Cfpb. This proposal would mean the government is in charge of determining if someone is creditworthy within the United States, a terrifying thought. This proposal comes only weeks after a hearing on the FinTech Task Force regarding central bank digital currencies, where the majority proposed on numerous occasions the idea of public Fed accounts and postal banking. This is what the slippery slope of socialism looks like, ladies and gentlemen. It's clear the majority is pushing for a world where not only does the federal government decide if you can get a loan, but they are the ones who in fact lend you the money. I urge my colleagues to go back to their districts and ask their constituents if that is what they want for the American financial system. My guess is they would be terrified that this proposal will receive serious consideration before this committee. With that, Madam Chair, I yield back.
I want to recognize today's distinguished witnesses to the committee. First, we have Mr. Syed Ejaz, a financial policy analyst with Consumer Reports. Next, we have Mr. Jeremie Greer, the co-founder and co-executive director of Liberation in a Generation. Next, we have Ms. Amy Traub, the associate director of policy and research with Demos. Next, we have Ms. Chi-Chi Wu, a staff attorney with the National Consumer Law Center. Last, we have Mr. Dan Quan, an adjunct scholar with Cato Institute Center for Monetary and Financial Alternatives. Without objection, your written statements will be made part of the record. Each of you will have 5 minutes to summarize your testimony. You should be able to see a timer on your screen or on the desk in front of you that will indicate how much time you have left. When you have 1 minute remaining, a yellow light will appear. I will ask you to be mindful of the time, and when the red light appears, to quickly wrap up your testimony so that we can be respectful of both the other witnesses and the committee members' time. Mr. Ejaz, you are now recognized for 5 minutes to present your oral testimony.
Thank you. Chairwoman Waters, Ranking Member McHenry, members of the committee, thank you for inviting Consumer Reports to testify regarding Americans' experiences with credit reporting and paths towards a better credit reporting system for consumers. The existing credit reporting system does not work for consumers. Too frequently, consumers struggle to access their credit reports, and when they do, too often they find that errors can limit their financial opportunities and can be difficult to correct. Inaccuracies on credit reports are not a new issue. In 2012, the Federal Trade Commission conducted a study on credit reports in which 21% of participants had found one verified error on the credit report, and 5% had errors so significant that they were put in a different credit risk tier. Complaints to the Consumer Financial Protection Bureau regarding credit reporting errors remain among the most frequent submissions to their database and have more than doubled since 2019. In February of 2020, in Consumer Reports' own American Experiences Survey, a nationally representative survey addressing a wide variety of consumer issues, 14% of participants who said they had checked their credit reports also said that they had found errors. This is unacceptable. Credit reporting agencies hold information that can be used to make consequential lending, employment, and in some states, underwriting decisions about us. Credit report errors that damage credit scores can keep people from affordable interest rates, as well as employment, and again, in some states, auto insurance. During February and March of this year, Consumer Reports asked volunteers to check their credit report and let us know about their experiences in a project we called Credit Checkup. Nearly 6,000 people responded to our survey and shared their stories. 34% of participants who checked their credit report told us that they found at least one error on their report. 29% said they found an error relating to their personal information, such as a wrong name or address. And 11% found errors relating to account information, such as mistakes about their account payment history. One participant, Victoria Ross, shared her story, which captures how much the credit reporting system can impact consumers. Her Transunion credit report mistakenly showed a PayPal account balance of around $1,200 that she had paid off, an error which led her to face unaffordably high interest rates when trying to find a car loan. Victoria filed multiple disputes, but was unable to get her credit report fixed until after Consumer Reports contacted Transunion. Victoria's story is one of many that show how an inaccurate, unresponsive credit reporting system can cause problems for consumers. 1 in 10 consumers who took our survey found that accessing their credit reports to be difficult or very difficult. Many consumers shared stories of being locked out of their credit reports because of identity verification questions that they simply couldn't answer because those questions were based off of inaccurate information. Some consumers told us that while they were checking their free credit report, they were pushed towards products and services that they would have to pay for. Multiple people said that they were asked for the credit card information before seeing their reports and later were charged. One told us, Transunion ran me through an exhausting series of questions, sales offers, and ridiculous permutations until I was able to get a credit report and score displayed. Then I found that they had signed me up for a monthly service and charged my credit card $27 and change for the first month to be charged monthly. I immediately canceled the subscription and had to call the helpline to get this charge removed from my card. These stories highlight just some of the problems that consumers encounter with a deeply flawed credit reporting system and are a fraction of the thousands that Consumer Reports has collected. Consumers need a credit reporting system that works for them, one where their reports are accessible and accurate and errors are easy to correct. The good news is that legislation that is discussed here today can help address some of the most glaring problems. For example, the Protecting Your Credit Score Act requires all credit reporting agencies and data furnishers to match first name, last name, date of birth, and all 9 digits of a consumer social security number when placing their information on their reports. This bill also creates a secure portal where consumers can freeze their credit, file disputes, and check their reports for free an unlimited number of times. The House can also pass the Comprehensive Credit Act once more. This bill gives consumers the right to appeal the results of dispute investigations, restrict the use of credit reports for employment, and implements many other common sense reforms to the credit reporting system. Credit reports play a central role in the lives of consumers, and the industry should center the needs of consumers first. A consumer-centric credit reporting system would put consumers in control of their own credit information, make it easy to access reports and scores for free, strengthen standards to ensure reports are accurate, and simplify the process for correcting errors. Congress can put consumers first by passing the Comprehensive Credit Act and the Protecting Your Credit Score Act. Thank you.
Thank you very much. Next, we will go to Mr. Greer. You are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and other members of the committee, thank you for giving us the opportunity to talk about racial bias and flaws in the current credit reporting system. My name is Jeremie Greer. I'm the co-founder and co-executive director of Liberation and Generation, which is a national racial justice movement support organization working to dismantle what we call the oppression economy and looking to build a liberation economy in its place. Within the oppression economy, credit reporting agencies such as Experian, Transunion, and others have anointed themselves as the gatekeepers with the power to determine who can and cannot access financial products, services, and the capital necessary to navigate the economy. They are the gatekeepers to a dual financial system that on one hand builds wealth of households through products and services like affordable mortgages and low-cost credit cards, but on the other hand, preys upon the financially insecure through products such as subprime mortgages, payday loans, auto title loans, and predatory credit building products and services. Our current credit reporting system both reinforces and exacerbates the dual financial system. Far too many people of color find themselves on the wrong side of this system because they are credit invisible. According to the Consumer Financial Protection Bureau, 15% of Black and Latinx consumers are considered credit invisible, meaning that they have no credit record at all, while about 13% are deemed to have thin or unscorable credit files. Also, other racial and economic disparities, such as income and neighborhood segregation, have a huge impact on someone's credit score. For example, take income. Black and Latinx median income is about $40,000, and the median white income is about $70,000. That means a study showed that by Experian and Hub Wallet Hub show that these levels of income mean that a Black and Latinx household would have an average credit score of 643 and 681, which is deemed bad or risky credit score, while an average white household would have an average credit score of 700 or 737, which is considered a good credit score. So what creates these disparities? A major contributor is the biased data that goes into calculating the score. For example, on-time payments, which favors things like mortgages and credit cards, but completely disregards often other forms of payments like a cell phone, rental payments, or utility payments that are more likely to be made by low-income consumers of color. Another example is a thing like credit history. In this case, you need credit to get credit, and historic barriers towards Black and Latinx communities have held back credit from those communities for a long time and not made them able to access credit. For example, think of a kid going to college where a parent is able to open a credit card account for their kid. That creates that credit. Many Black and Latinx households are not able to do that. They're not able to pay off their child's student loan debt. They're not able to co-sign an auto loan because of the lack of access to credit in Black and brown communities. Sadly, research from the Cfpb shows that the reality of being credit invisible or having an unscorable account at an early age makes people suffer for a long time and in the near term. To end this dual financial system, we must reform these credit reporting agencies. And efforts like the bills that passed out of this committee that the Congresswoman referenced, including a public agency responsible for protecting consumers, having accountability and transparency in the system is also critically important. We look forward to efforts that improve our credit scoring system, and we look forward to working with the committee to create those. Thank you for allowing me the time to address you.
Thank you, Mr. Greer. We will now go to Ms. Traub. You are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, and members of the committee. My name is Amy Traub, and I'm Associate Director of Policy and Research at DEMOS. DEMOS is a dynamic think tank that powers the movement for a just, inclusive, multiracial democracy and economy. One of our core principles is economic democracy, the idea that we, the people, must be able to exercise real power over the economic decisions that shape our lives. We focus on Black and brown communities that have been largely excluded from economic decision-making. In my testimony this morning, I'll make the case that credit reporting is part of our nation's financial infrastructure, necessary to full economic participation and thriving. I'll share evidence of systemic racial inequity in credit reporting, and will show that the many failures of the system arise from the structure of the industry, and thus require structural change. Finally, I'll argue that publicly controlled credit reporting offers the best opportunity to rebuild the system and ensure that it operates in the public interest and promotes racial equity. DEMOS welcomes the introduction of the National Credit Reporting Agency Act, which would shift power to consumers by enabling them, for the first time, to opt out of the flawed private credit reporting system and choose a fairer public option. We look forward to continuing to work with the committee to further strengthen this bill. We also support the Comprehensive Credit Act, which would directly reform private credit reporting, and urge Congress to enact this legislation. Credit reports and scores play a large role in determining Americans' access to economic security and opportunity, including access to housing, transportation, employment, and entrepreneurship. The credit reporting system is a gatekeeper to such a broad range of economic opportunities that it forms a core part of our nation's financial infrastructure. Yet this privately controlled infrastructure is failing consumers. My fellow witnesses describe the outrageous inaccuracy of credit reports, the nightmare process of getting errors corrected, and numerous other failings of the system. The most devastating failure is the way that credit reporting reproduces and spreads racial inequality. Although credit scores never formally take race into account, they draw on data about personal borrowing and payment history that is shaped by generations of discriminatory public policies and corporate practices that limit access to wealth for Black and Latinx families. Discrimination in employment, lending, housing, and education have produced significant racial disparities in credit history, so that today credit scores disproportionately represent Black and Latinx consumers as riskier than white consumers. As a result of this disparity, whenever credit data is used in decision-making, it multiplies inequality. Transforming credit reporting is very far from the only step needed to address racial economic inequality, but it's a powerful tool to disrupt that cycle of disadvantage. Although the vast majority of American consumers rely on credit reporting to access economic opportunity of all kinds, the credit reports of more than 200 million Americans are controlled by just 3 private companies: Equifax, Experian, and Transunion. As private corporations, the aim of the credit reporting agencies is to generate profit, which they do by extracting, packaging, and selling data about consumers' personal borrowing and payment activity. Since consumers are not the customers of the private credit reporting agencies, they have no market mechanism to demand accountability or fairness. Consumers cannot opt out of the system or choose to work with a competing company. In effect, by controlling credit data, the 3 credit reporting agencies have consumers at their mercy. They have arbitrary, unaccountable power over all of our financial destinies. The oligopolistic structure of the credit reporting industry is the reason that it's failing American consumers. The many problems we're discussing today all stem from the fact that credit reporting is part of our public infrastructure that's under a private stranglehold by 3 companies. Congress can and should continue to regulate the industry, yet without tackling the flawed structure of the industry itself, Congress and the regulatory agencies will always be playing a game of catch-up with a private industry that has no built-in incentives for accountability to the consumers whose financial fate it shapes. This is why DMOS has proposed a public credit registry designed to be responsive to consumer needs and equity concerns rather than the corporate bottom line. My written testimony describes why a public credit registry is needed to serve the public interest and how it will develop algorithms that diminish the impact of past discrimination, deliver transparent credit scoring, improve accuracy, and offer a publicly accountable way to address disputes. Thank you.
Thank you, Ms. Traub. We will now go to Ms. Wu. You are now recognized for 5 minutes to present your oral testimony. Ms.
Thank
Wu?
you, Madam Chair. Thank you, Madam Chairwoman. Can you hear me?
Yes, I can hear you.
Thank you. Madam Chairwoman, Ranking Member McHenry, and members of the committee, thank you for inviting me to testify today. I'm testifying on behalf of the low-income clients of the National Consumer Law Center. Members of the committee, the Fair Credit Reporting Act is 50 years old, half a century. And in those 50 years, the credit reporting system has been broken and biased. It remains broken despite multiple enforcement attempts by the FTC, nearly 10 years of supervision by the Cfpb, and 2 multi-state settlements by state attorneys general. It remains broken after 50 years of private litigation with tens of thousands of lawsuits by injured consumers, including several eye-popping multi-million-dollar jury verdicts. It remains broken after 2 rewrites of the FCRA in 1996 and 2003 to attempt to address credit reporting abuses. It's consistently favored the interests of creditors, debt collectors, and the like over the rights and interests of consumers. The result has been unacceptable levels of errors, a biased Kafkaesque system that automatically rules in favor of industry during disputes, and stark racial disparities that perpetuate systemic racism. We can see how broken it is from the over 300,000 complaints to the Cfpb in 2020 about consumer and credit reporting. That's a lot of complaints. It's twice as much as 2019 and nearly 2/3 of the complaints to the Cfpb last year. And of course, you have the FTC's 2012 study that 20% of consumers have a credit report with a confirmed error, with 5% having a serious error. That's 10 million Americans who have errors so serious on their credit reports it could deny them credit, a job, or an apartment. literally a roof over their heads. And without firm action by Congress, it's only going to get worse. Just this past Friday, the Supreme Court issued a ruling in a case called Ramirez versus TransUnion that'll make it even harder for consumers to vindicate their rights under the FCRA. The Supreme Court held that a credit bureau can wrongfully accuse a consumer of being a terrorist, a drug dealer, or worse. And the consumer can't even bring a lawsuit because that alone doesn't constitute concrete harm. Imagine that. They have to first have a creditor, landlord, or employer see the falsehood and suffer having their reputation besmirched and ruined in the eyes of a complete stranger before the courthouse doors will open. As Justice Thomas, Clarence Thomas, said in a fiery dissent, if this sort of confusing and frustrating communication is insufficient to establish a real industry, one wonders what could rise to that level. If instead of falsely identifying Ramirez as a potential drug trafficker or terrorist, TransUnion had flagged him as a potential child molester, would that alone be insufficient to open the courthouse doors? What about falsely labeling someone a racist, including a slur on the report? What about openly reducing a person's credit score by several points because of his race? If none of these constitutes an injury, how can that possibly square with our past cases? So Congress needs to act. Only Congress can fix this, and Congress must fix this because it hasn't gotten better in 50 years, and it's only going to get worse. Make no mistake, the Supreme Court's Ramirez decision will most certainly embolden the credit bureaus to act with even more impunity, favoring the interests of banks and debt collectors even more, and be even more blithe about abusing and mistreating consumers, knowing that there are even fewer checks on their behavior. We need a public credit registry now so the financial reputations of consumers aren't held hostage to the profit-making interests of Equifax, Experian, and TransUnion to fatten their bottom line. Thus, we support the proposal in the National Credit Reporting Agency Act to establish a public option credit registry so that consumers have a choice. A key reason for the abuses of the credit bureaus is consumers can't walk with their feet. We're captives. A public credit registry should and would allow us to walk with our feet, walk away if we're unhappy with the credit bureaus. And if the credit bureaus are allowed to continue, we need wholesale reform. We need laws like the Comprehensive Credit Act and the Protecting Your Credit Score Act. To address the awful Ramirez opinion, we need injunctive relief under the FCRA, which the majority opinion in Ramirez specifically noted could reopen the courthouse doors. But a number of courts have held the FCRA doesn't provide for injunctive relief, the ability to simply ask a court to order a credit bureau to fix that report. 50 years of abuse is enough. We need a public credit registry and wholesale reform now. Thank you for the opportunity to testify and look forward to your questions.
Thank you very much, Ms. Wu. As a reminder, all witnesses who are participating virtually should keep their cameras on for the duration of the hearing, even when they are not speaking. With that, we'll go to our next witness. Mr. Quan, you are now recognized for 5 minutes to present your oral testimony.
Thank you. Chairwoman Waters, Ranking Member McHenry, and distinguished committee members, my name is Dan Chen. I'm an adjunct scholar at the Cato Institute's Center for Monetary and Financial Alternatives. I'm also a venture capitalist and an advisor to fintech startups. I'm honored to be here today. It is not just my titles or expertise that makes my testimony unique. It is also because, as a new immigrant to this land of opportunity, I know personally what it is like to be credit invisible, to build credit from scratch, and to dispute an error. I also know how empowering access to credit can be. My wife and I once had to choose between groceries and prescriptions. Thanks to our excellent credit scores, we were able to get low-cost loans to overcome those tough times. My testimony is focusing on the Public Credit Bureau proposal. Before I begin, we should acknowledge that our consumer credit market, the largest and the most competitive in the world, depends on a functioning credit reporting industry. And the other witnesses have correctly pointed out, the credit reporting industry has many issues, but the industry is not fundamentally broken. What it needs is appropriate policy interventions and more private sector innovations to improve equity in credit access and also improve accuracy, security, transparency, and accountability. There has been a sea change in the credit reporting industry in the last 10 years. Credit bureaus have been subject to the Cfpb supervision since 2012. Improving accuracy has been a top priority for the agency. The industry is also evolving as technology advances. New credit score models, such as Experian Boost and Ultra FICO, allow consumers to use their on-time bill payment history to increase their FICO scores. Some lenders are also using cash flow data to expand access to credit. 10 years ago, consumers could only obtain one copy of free credit reports once every 12 months. Today, consumers who have an internet connection or a smartphone can get free credit reports and free credit scores easily. All the policy goals outlined in the Public Credit Bureau proposal can be adequately and effectively achieved by improving the existing system. In addition, I'm also very concerned about the negative consequences of such a government-run credit bureau. First, the Public Credit Bureau may pose a significant threat to consumers' privacy. The federal government will score everyone and maintain a huge database that monitors every aspect of our financial lives: how much we owe, who we borrow from, how much we pay, where we live, and who we work for. Putting so much sensitive personal information in the hands of the government, especially when consumers have no way of opting out, should be a concern big enough to override any potential merits. Second, the cost of setting up and running the Public Credit Bureau needs to be seriously considered. The Cfpb has a workforce of about 1,500 employees and an annual budget of around $600 million. The smallest national credit bureau employs over 8,000 people and has an annual operating cost of more than $2 billion. Well, those are not apples-to-apples comparisons, but they give us a sense of how much the federal government needs to be expanded to run the Public Credit Bureau. Finally, the Public Credit Bureau will crowd out private investment and ultimately monopolize credit reporting. Competition will be reduced to zero, and the innovation in expanding access to credit will cease to exist. I have the following recommendations. First, refreshing the accuracy study. The landmark FTC accuracy study was done over 10 years ago. Much has changed. A new study is long overdue. Second, imposing federal supervision of data security. Credit bureaus should be held to the same standard as financial institutions when it comes to data security. Congress needs to act quickly. Third, reforming the dispute process. The dispute process should be made easy for consumers. Consumers should have the right to dispute directly with furnishers. Finally, protecting consumers' data rights under Dodd-Frank, Section 1033. Consumer permission data access is key to reducing racial disparities in credit. Unfortunately, many large financial institutions have too often illegally created obstacles to data access. It is imperative for the Cfpb to write a pro-consumer, pro-competition, and pro-innovation rule. Thank you for the opportunity to provide this information, and I welcome any questions that you may have.
Thank you very much, Mr. Wu. I'm sorry, Ms. Wu. I'm deeply concerned about the effects of this devastating pandemic on homeowners and other consumers, especially those who are not able to dispute inaccuracies and errors on their credit reports. In my opening statement, I discussed a letter I received from a man in Ohio who lost his job, couldn't keep paying his bills, and as a result, saw his credit score drop. But it's not just him. Let me give two more examples from consumers from my home state of California who recently submitted complaints to the CFPB about these issues. The first is a homeowner whose mortgage showed up on credit reports as deferred because of COVID. The consumer said they did not sign up for payment assistance, and their bank confirmed that the account was current. Another person complained about the lack of response from the credit reporting agencies saying, quote, "I've been filing disputes with all of the credit bureaus and I'm getting nowhere. With COVID going on, I understand that things are taking longer, but this is not right. I'm trying to clean up my credit and I'm getting the run around from the bureaus, quote unquote. Ms. Wu, in your experience, how do these types of errors and inaccuracies affect a consumer's ability to access credit?
Uh, Thank you, Madam Chairwoman. These types of errors you describe can be devastating to a consumer's ability to access credit. They can cost thousands, if not deny them ability to get credit or even a job or an apartment. There are a lot of them. The reason I think you see a doubling of complaints about credit reporting to the CFPB is because of these very issues caused by the pandemic. Consumers getting forbearances but being wrongfully reported, or not even getting them and being reported for a forbearance. That is why we had advocated for just a moratorium on negative reporting during the pandemic, just recognizing the devastating economic consequences. And the House passed that in the HEROES Act, but unfortunately the Senate didn't. On a long-term basis, we need the ability for consumers to dispute errors, and then if they can't get them fixed because the credit bureaus automatically defer to the information providers, the furnishers, we need a right of appeal or an ombuds function and a right of injunctive relief to fix those credit reports.
Thank you. Mr. Greer, in your testimony, you described the current credit reporting system as a tool for social gatekeeping, used not only as the basis for credit and lending decisions, but a system that also is used by companies making employment decisions, landlords considering prospective tenants, and insurance companies pricing their policies, while individuals are held to account every time they miss a payment and even see their credit score drop when they shop for credit. The big credit reporting agencies have skirted responsibility time and time again for their misdeeds, as recently shown by increasing complaints to the Consumer Financial Protection Bureau and litigation during the pandemic. Mr. Greer, given the system's impact, do you think Congress really needs to consider bold reforms such as creating a public credit reporting agency that consumers could choose to use as an alternative to the private credit bureaus and profit off the use of their data? You heard what the opposite side was saying about the government should not be in this business at all. Tell me what you really think.
Thank you, Chairwoman Waters. I think it's the credit score and our credit record has become much more than a tool to use to determine whether you can purchase a mortgage or whether you can get a credit card. It's become a tool that's used to decide whether to offer employment or to rent a car, or whether you can get a cell phone. If you're a domestic violence victim, could you get a cell phone to protect yourself from your batterer? It has taken a huge, important, and central piece of our daily lives. And because of that, entrusting it in the hands of private sector people who are responsible to their shareholders and to their customers. And the customers are not us. We are not the customers, we are the product. The data that we provide is the product that they sell, and they sell it to financial institutions, which is why it's so important that we have a customer-centric institution. And I think the idea around putting it in the federal government's hands is a good one, to protect consumers and to protect us so that we can operate within society in the credit markets and in the employment markets and in rental markets. So I think that this is critically important. Thank you.
Well, thank you very much. A few more seconds are left here. I think one of the most egregious problems with this is deciding whether or not someone is employable. And who is impacted by that?
It is Black and brown communities. This is communities of color. It exacerbates the barriers that communities of color already face in the employment market, whether it's criminal history backgrounds, whether it's the neighborhoods they live in, ability to get from transportation to work, but then you add this on top of it. And with all of the disparities that Ms. Wu and Ms. Traub have talked about, it really drives those disparities.
Thank you so very much. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Well, let's go fix the problem. Let's not recreate a new problem. Mr. Quan, my question for you is, this is all about creating a government-run credit reporting bureau. That's exactly what this hearing's about. You want a government-run agency. Instead of seeing three large credit information furnishers operating as an oligopoly, you're going to have a monopoly with a government agency. And rather than having three different sets to compare, as imperfect and in need of reform as it is, the idea that you're going to say we have a problem because we have three different credit reporting agencies, and now we're going to have one, and it's going to be the government. Who are you going to sue when the government puts the screws to you? Good luck with that, right? I see this as a problem. Not that the challenges outlined by this panel aren't, in fact, the things that we need to address. I think addressing it by just shoving it into a government agency is going to make things worse, not better. For my constituents, for my colleagues' constituents, regardless of what you look like, a credit score, if you're poor, is a bad thing. Across the board. So we need to go get at the root causes of this, and we need better data provided. And we've heard from the panel, and they said, let's use alternative data. I agree. We can do that in a bipartisan way. We can, in fact, make law. But instead, if you want this to be a government takeover, and that's what the whole debate is about, you're not going to have any discussion about what Republicans have offered as a solution, then we're going to have a standstill here. Nothing got done last Congress on this. Nothing's going to get done this Congress on it because there's no willingness to have a bipartisan conversation about the things that are achievable in a bipartisan way. Mr. Quan, your written testimony outlines major flaws of the concept of a government bureau being the arbiter of credit. Highlight your primary concern with that, if you would.
Thank you, Congressman. As I have written in my written testimony, all the notable policy goals in the Public Credit Bureau proposal can be effectively achieved by reforming the industry today. We have the most competitive credit market in the world, and this industry is not broken. It's got many issues. And in addition to failing to achieve these goals, or put another way, by more effectively achieving these goals by reforming the existing industry, I think the Public Credit Bureau proposal has the following major problems. Intrusion of privacy. So we now have a government that can really monitor every aspect of our financial lives. That is huge concern. And if we think the government has already known too much enough about us, I think this bureau is going to make things even worse. Then we talk about the cost and the potential waste of funding. I already mentioned some big numbers in my oral statement. Let me give you a few more numbers. According to a research firm, Standish Group, they found out between 2003 and 2012, only 6.4% of the large federal IT projects succeeded. 52% were over budget, delayed, or didn't meet expectations. The other 41.4% were complete failures. And have we learned more enough from the recent rollout of the vaccine appointment system, which the federal government spent $44 million on? It never even worked. And not to mention the continuously poor quality in federal student loan servicing, and more than 10 years ago, the botched rollout of healthcare.gov.
All right, Mr. Quan, to that point, cyber attacks are also a major issue with federal databases. We've seen this as a federal employee and former government employees, maybe on the panel, and employees of executive branch agencies have had their data stolen. So the idea that as the government agency doing this will be a better steward of our data is quite questionable given the track record of the federal government. Additionally, I think we all can agree the procurement process for IT and technology for the federal government needs reform as well. So we've got a whole set of issues that are quite challenging to create a database like this before you even talk about the question of its level of security, before you talk about the cost. And I think there are enough questions here that I think what I would offer to my Democrat colleagues is what I offered last Congress. Let's try to do the work that is bipartisan that we can achieve in this sphere and make things better. And make things better, even if you still have your goal of a public credit registry. Let's do the things which I completely disagree with. Let's do the things that are a modest improvement or a significant improvement for our constituents that are achievable today. And I think we have some ideas put forward for the panel. I'd love to have that bipartisan cooperation here in this committee. And with that, I yield back.
Thank you very much. The gentlewoman from New York, Ms. Velasquez, who is also the chair of the House Committee on Small Businesses, now recognized for 5 minutes.
Thank you, Madam Chair. Ms. Wu, the Cfpb began handling consumer complaints about the credit reporting industries in 2012. Since that time, complaints about the CRAs continue to be one of the largest categories of complaints handled by the Bureau. For example, in 2020, the Bureau handled about 542,000 complaints, approximately 58% of which were regarding the CRAs, which was the largest category of complaints reviewed by the Bureau. What do you think such a consistently high number of complaints per year over years says about the state of this industry?
Thank you, Congresswoman. I think it says exactly what the title of this hearing says, which is that the credit reporting system is broken and it's biased and it needs fundamental reform. I think that's why we need a public credit registry option. The bill discussion draft makes it an option so that consumers have true, meaningful choice. If they don't like the credit bureaus because they commit so many errors and have for decades, they have the choice of a public option. And to address some of the points before about cybersecurity, are we forgetting 4 years ago about the Equifax data breach? How one of these credit bureaus lost the personal or let hackers take the personal information of half the American adult population? You know, in terms of privacy, our data is with 3 private corporations that monetize and exploit it and don't do a very good job of making sure it's accurate as seen by all those complaints.
Thank you. I have other questions.
Okay, sorry.
Ms. Wu and Ms. Traub, one of my biggest frustrations with the big R CRA is that they have developed a system where the consumer has little to no control. Consumers never directly sign up as a customer. They have no control over whether a furnisher provides their information to a CRA, and they cannot stop doing business with a CRA if they are dissatisfied or simply choose to opt out. Both of your organizations have supported the idea of public CRA. Can each of you explain why you favor such a proposal and how a public CRA will provide more accountability and transparency and provide the customer with a fairer and more beneficial system?
Thank you, Congresswoman. It's absolutely true that the private system is failing us, and DMS has proposed a public credit registry. Since consumers are not the customers of the private credit reporting agencies, we have no way to demand fairness or accountability through the market. Consumers can't opt out of the system. And so the 3 private credit reporting agencies really have consumers at their mercy. They have this arbitrary, unaccountable power over our financial destinies. A public credit registry, why we support it is because it's a way to take back power for consumers and make sure that credit reporting operates in the public interest with a lot of mechanisms for public accountability, not government control. A transparent process for credit scoring is one important element of that. That doesn't mean everyone knows your credit score. It means everyone knows how credit scores are determined. A public dispute resolution, a dispute resolution process that actually enables consumers to present evidence and see the evidence on the other side. And as a last resort, the right to take the public registry to court over errors, and as well as enhanced accountability from companies that furnish the data to the public credit registry.
Thank you. Thank you. Ms. Traub, as you know, many LMI communities and community of color access credit from alternative financial service providers. Unfortunately, however, many alternative financial service providers do not report positive credit payments to the credit reporting agencies. Can you explain how consumers who access credit from these markets fail to gain the benefit of making positive payments and how this can hurt them in the long term, in the long run?
Absolutely. Thank you, Congresswoman. Right now, many types of alternative credit sources do not report. And therefore, when people are paying their cell phone bill on time, a payday loan on time, that doesn't turn into positive credit in the way that paying a mortgage on time would. Our proposal for a public credit registry allows consumers to opt in to other types of reporting, other types of payment history. We think it's important that consumers be able to opt in because there are cases when it.
Gentlewoman's time has expired. We'll let you either answer that in writing or somebody else will let you finish your answer.
Thank you.
Chair will now recognize the gentlewoman from Missouri, Ms. Wagner.
I thank the chair. Mr. Quan, what would happen to the availability and the cost of credit if we eliminated entire categories of debt from credit stores?
Thank you, Congresswoman. That's an excellent question. The reason we have the most competitive consumer credit market is because the lenders have as much information as accurate as possible about the consumer. If we eliminate accurate information, well, some information may be negative, may be detrimental to individual consumers, depending on the circumstances, but regardless, it is accurate. Lenders will not be able to make the best decisions in the lending decisions. As a result, the cost of credit will increase for everybody, and the availability of credit will decrease for everyone.
Thank you. Should the goal of reform be to increase the number of qualified borrowers or to lower the bar so low that it jeopardizes the system for others?
Of course, it has to be the former, not the latter.
Generally speaking, do you believe that competition creates better products and generates better outcomes for consumers?
Of course, without competition, nobody will have any interest. Lenders will have no interest in improving their credit, improving their products or lowering the cost. With the competition, we have more expanded access to credit. More consumers can qualify for credit.
Now, knowing that competition benefits the consumer, which is what's very important to my constituents in the second district, again, cost and access. Tell me, how does a one-size-fits-all government-run credit bureau benefit the credit system or the consumer?
Well, since we talk about competition, as we have heard the word opt-in, right? So the consumer, if the consumer doesn't like how they are treated by the private credit bureau, they can opt into the government credit bureau, which supposedly is better. But here's the thing, the government credit bureau is backed by unlimited taxpayers' money, revenue. So private bureaus, they have to answer to shareholders. They don't have unlimited financial resources, okay? So at the end of the day, this is not an opt-in system. This, at the end of the day, if we're not happy with the current situation of the three major national credit bureaus dominating credit reporting industry, if we have a government-run bureau, at the end of the day, there will be only one bureau, which is a public bureau, and there will be no competition whatsoever.
I agree wholeheartedly. What would you recommend for as an alternative to the bills being proposed today that would improve cybersecurity, reduce data errors, and bring about a more inclusive credit system?
Well, I do think regarding accuracy, so we have heard opposite stories from consumer groups and from the industry. And frankly, the most authoritative study on accuracy was done over 10 years ago. Many things have changed. It is imperative that we have another study be done, either by the Cfpb or by the FTC. Without evidence, we cannot make good policies. So that's number one. Number two, I think we should increase competition. So I mentioned technology innovation can help. I mentioned in my last recommendation, which is the CFPB should write a pro-consumer 1033 rule. That rule will open up the opportunity for consumers to furnish their own payments data, which is not allowed currently in most cases in credit bureau furnishing. So if that data can be used in credit underwriting, we'll see more consumers potentially qualify for credit and for affordable credit.
I thank you, Mr. Quan, for your very, I think, specific analysis and the alternatives that you have offered here today. I agree that if the government takes this over, we will have just a one-size-fits-all government-run system. Competition is needed in this space, and I thank you very much for your input here today, and I yield back. Thank you.
Thank you.
Gentlelady yields back. The gentleman from Georgia, Mr. Scott, who's also the chair of the House Agriculture Committee, is now recognized for 5 minutes.
Thank you very much. Perhaps the most paralyzing issue in this that we can address quickly with coming up with some answers deals with student loan debt. And Mr. Greer, I have looked at recent data from the Student Borrower Protection Center. You may be familiar with that. It shows a widening gap between private student loan usage and outcomes between Black and white borrowers. Black students, it says, are 4 times as likely to struggle in repayment of private student debt in comparison to their white peers, despite being less than half as likely to take out a private student loan. That's why I say the student loan issue is one, and I might just refer to some of the comments from the other side. But this is a very serious racial issue. The impact this has on a young borrower's credit score can have significant, it does, long-term consequences, such as making it more difficult to get a job, buy a car, own a home. This is a paralyzing issue. So, Mr. Greer, I found it interesting in your testimony. Here's what you said. You said that the current system overlooks many in our community because their monthly expenses do not go toward a more traditional credit product like a home or a credit card. They don't have them. And penalizes consumers for holding less traditional credit products or bad debt, such as unpaid student loan debt. So, Mr. Greer, can you explain why unpaid student loans, particularly private student loan debt, even when a borrower is current on that loan, is viewed by creditors as bad and continues to be used as a driving factor in limiting credit worthiness, especially for Black borrowers, 4 times as great? Mr. Greer.
Well, thank you, Mr. Scott, for that question. It's such an important issue, and I do want to acknowledge the work that Demos has done on student loan debt and raising up those racial disparities that you talked about, Mr. Scott. I mean, it all comes down to, you know, the credit bureaus treat student loan debt because it can't be offloaded through bankruptcy, in the worst case, more harmful in their algorithms. And I'll give you a little anecdote of my own. You know, my wife and I wanted to buy our first home. And this was, you know, about 15 years ago. And we were working with our you know, our mortgage lender, and they said, you know what? And they were like, you know what? I could get you a better rate if you make a huge payment to your student loans. Well, we didn't have a lot of money. That came out of our savings. We had to pull that money out of our savings. And so we had to make a choice between pulling money out of our savings would have went into the home equity of the house versus making a payment to a student loan company in order to get a better interest rate. Those are the type of difficult decisions that these credit bureaus place for consumers, is that and actually cuts at the wealth of people who are in the housing market, or people who are looking to start a business, or many of the other wealth building activities that people need access to credit for. So thank you so much, Mr. Scott, for raising this, because it's such a critical issue and a huge problem within the system.
Thank you very much.
Gentleman yields back. Next, the gentleman from Florida, Mr. Posey, is recognized for 5 minutes.
Thank you very much, Mr. Chair. Mr. Quan, can you please explain why the information provided by credit reporting agencies is essential to the efficient functioning of lending markets?
Thank you, Councilman Posey, for the question. So lenders need information to underwrite consumers. So the information housed in the 3 credit bureaus and any credit bureau is essential for lenders to make the right decision. All these decisions are based on the risks that they perceive, or in other words, they have to project the likelihood of the consumer's ability or willingness to pay the debt once they loan the money. So the information is essential. That's why it's important to have accurate information in the database. And it's also as important to have complete information in those databases. And when I say accurate, it means both positive and the negative. Negative information is bad for the consumer in terms of getting credit or getting a affordable interest rate. But for the entire system, negative information, if it is accurate, is very important.
Thank you. Mr. Quan, the title of this hearing is A Biased, Broken System, Examining Proposals to Overhaul Credit Reporting to Achieve Equity. Does this make sense as a policy criteria or objectives for regulating the credit reporting system? You know, what should the objectives be?
Well, I think both the Democrats and Republicans, I think we have the same objective, which is we have to make sure we want to make sure we have a fair system for everybody, regardless of your gender, your color, your religion. Everyone, if they can qualify for credit, they should be able to get credit. But obviously, we'll take different approaches here. We believe, and I believe, the current system is flawed, but it is not broken. It will be far more effective and more cost-effective to improve, to reform the current system than to tear it down and build a new one.
Thank you. You know, last year you wrote an article commenting on the president's proposal to create a public option at the Consumer Financial Protection Bureau for credit reporting. Would you share your views on that topic with us, please?
Sure, yeah, as I have already shared my view in my written testimony as well as in my oral statement. I think that is a proposal that is going to be very, very costly to taxpayers. And more importantly, it is not going to effectively fix the problems. And frankly, this is not a opinion of more market driven people like me. Even a Georgetown professor, Adam Levitin, he is a very known scholar in the legal field on consumer finance issues. He also wrote a blog post earlier this year and questioning the viability of a public credit bureau. All the problems we have today will not be fixed by the public credit bureau.
Thank you. Do you think the current credit reporting system operates with intentional bias to exclude certain groups from access to credit?
I would not say they have this intention to exclude people of color. We do have a problem, which is 45 million Americans, many of them probably disproportionately Blacks and Hispanics and people of color who don't have access to credit because they don't even have a file in these databases. That is why it is important for all of us to have a very conducive environment to promote, to facilitate innovation. And innovation is already happening. We see, I mean, in my written statements, I already mentioned Ultra FICO and Experience Boost. They are allowing consumers to link, to furnish their payments data to utility bills, streaming subscriptions to credit bureaus to be factored into their FICO scores. And then we have seen for Experience Boost, 69 million points have been boosted.
You've advocated for innovations in financial markets, including credit reporting, especially the incorporation into credit files of new data sources to help, quote, credit invisibles get access to credit. Could you please tell us how the private sector is responding to this challenge and what can be done to encourage even greater innovation?
Sure. Yeah, I just mentioned. There's Ultra FICO. There's a Experience Boost, and so this innovation would not take place if we didn't have open banking or open finance in the United States. Or more specifically, consumers must have the right to permission third parties to have access to their bank account data, such that the data can be used in credit scoring system. And we've seen other innovations here. So I can give you two more examples.
I got to thank you. My time's running out, Mr. Quan. Thank you very much.
Thank you.
Mr. Posey's time has expired. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. I greatly appreciate the opportunity to be heard. And I greatly appreciate the staff for what they've done to assist with what I'm about to bring to the attention of our committee. HR 123, the Alternative Data for Additional Credit FHA Pilot Program Reauthorization Act. This is something that we were successful with. It became Section 2124 of the Housing and Economic Recovery Act of 2008. It did not get funded, and as a result, we're bringing this back because we believe this would be something that should be funded and it will be of great benefit. And I'm appealing to all of my Republican friends across the aisle from me, all of them. I'm willing to work with all or anyone who'd like to work with me on this. I am very much interested in being bipartisan, very much interested in working with people, regardless as to who they are. So if someone would like to work with me on this project, I would greatly appreciate your making yourself known to me. More specifically, we know that in this country, depending on who's counting and how you count, we have about 45 million people who are credit invisible or unscorable. And as a result, they don't get the opportunity to make the purchases that many of us take for granted. This piece of legislation would allow your light bill, gas bill, water bill, phone bill, cable bill, your utilities to be scored. Mr. Greer, you've spoken of this, these utilities being scored. This bill allows you to opt in and score these utilities. And if they benefit you, then you can take advantage of that benefit and have the credit that most of us take for granted. So I ask you, Mr. Greer, HR 123, give me your thoughts on what I'm sharing with you at this time in terms of doing this, making this change such that we can do this with HUD. HUD would be have the pilot program, and we would use a commercially available credit reporting model. Your thoughts, Mr. Greer?
Thank you, Mr. Green, for raising that, for your work on this this important issue. I say, one, you emphasize the importance of opting in. I think that's a big important point, and that consumers should have the choice around what data is being used to assess their credit score. The second point on that I'd like to make is, a lot of this conversation about alternative data, it's already a part of the system. It's just that the negative stuff is what is being reported. If you don't pay your utility bill, it gets reported. If you don't pay your cell phone bill, it gets reported. So what I'd like to see is, if we're going to use alternative data, let's make sure that we're bringing in the positive payments. Because, you know, if I miss a payment on my utility bill, or my utility gets cut off, I'm going to get dinged for that. But what's not going to show up is the many months beforehand that I paid my utility bill on time. And I think that it's important, one, that we opt in and that we make sure that we're reporting the positive activity that is happening with people, as in addition to the negative activity that's already being reported.
And let me add something. We would also want to make sure that people understand that this is additional credit, not just alternative, meaning we'll take this in lieu of other things. This is additional credit that can be added to your credit score to help you. Ms. Traub, I hope I'm pronouncing your name correctly. Would you comment on this as well, because you did bring up the need for this type of credit scoring? Am I being
Is this
heard?
this is a question for me?
Yes, ma'am.
Alternative data. Yes, I think it's important that consumers be able to opt in to using alternative types of data, as Mr. Greer said. I also think that a public credit registry could look into which types of data it's inappropriate to include. For example, medical debt has been shown, and we should do more studies to show this more conclusively, not to be predictive of people's ability to pay other types of debt. When someone takes on a mortgage or a credit card, they have a chance to think about, what are the terms? Do I want to take on this debt? When you are sick, or your child is sick and needs medical care, needs to go into the hospital, you don't know how much it's going to cost. You may not care how much it's going to cost at that point. You just want your loved one to get the care they need and be okay. And then you're saddled with hundreds, thousands, maybe even millions of dollars in medical debt. Should
My
that
time
go
is
on your credit
about to
report?
expire. Ma'am, let me just ask you, without
you.
question, reservation, or hesitation, you do agree that additional credit scoring is important, what you're calling alternative credit scoring?
Yes, I think we need to look at different things that should be included and excluded from credit scores to make them more fair and predictive.
All right, well, thank you very much. I yield back the balance of my time. I believe my time is over.
Gentleman's
Thank you, Mr.
time
Chair.
has expired, and he yields back. Gentleman from Missouri, Mr. Luetkemeyer, is now recognized for 5 minutes.
Thank you, Mr. Chairman. You know, it's interesting that we believe that government can do something better than the private sector. You know, I heard numerous of the witnesses today talk about all the errors that are made by the private sector credit bureaus, and I'm not defending them. They're not perfect. They're human. They make errors. But if you believe the government is going to make less errors than the private sector, who has to be responsible for being able to have good information out and can be sued for it, which the government cannot, you're either naive or misinformed or worse. And I can tell you right now, as being a ranker on small business, the PPP program, which was administered through the banks, had huge advantages over the EIDL program. The EIDL program was completely administered by the SBA. It's got almost a third of the loans are fraudulent. If you expect the government to be able to put together a program that is going to be error-free, you're in a wrong planet. Along that line, the government's going to have more errors, I believe. Mr. Quan, I got a question for you on this. Listen very carefully. I believe the information you're going to get is very poor information because it's not going to be complete. Government delays everything. Think IRS. Do they do anything on a timely fashion? No. This is another agency that's going to be riffed with fraud, riffed with delays, with incompetent and incomplete information, old data, delays in getting it fixed. And what does that mean? That means if you're a lender, are you going to rely on this information? I don't think so. If you're a lender, if you rely on just this agency alone, because it's poor information, I would think you're going to increase the cost of the loans you make on this information and probably have less access to credit. Mr. Quan, am I wrong?
You're absolutely right, Mr. Congressman.
Thank you for that. Along the line of why would anybody want to do this? Why would we want the government to get in to having more information like this? Ms. Traub gave us the answer. She said it's about control. Control what? Control information, control who gets loans, who gets financed. Guess what? Again, think IRS. You're using and weaponizing another agency here against people who they disagree with, either politically or for any other reason. Think Operation Choke Point. Here we go again. The government is picking winners and losers and picking out people who may be doing nothing wrong, have a legal business, have a legal right to access to credit, and yet the government's getting in the middle of this and scoring them in a way that's detrimental to their ability to get loans and whatever. Am I wrong on that, Mr. Quan?
You're also absolutely right.
Thank you very much for that. The other thing I want to talk about here a little bit is lenders. Why? We're talking about credit scores this morning. Why? Because people need access to credit. The lenders need this information to be able to judge accordingly whether somebody is worthy of loaning money, be it a home, a car, a business, whatever. They assess risk. The interest rate is always reflective of risk. And the more information they have, the better they can assess the risk. If the lenders have incomplete amounts of information, this is why you see the private sector credit bureaus trying to find more ways right now, even though they're not required to take some of these different things like rent payments, utility payments, telecom payments, service streaming payments. Those are all being used right now by a lot of the different private sector folks to assess risk, to be able to assess an individual's ability to get credit. Those are important things. I support those. We had a bill out of here not too long ago, a year or two ago, that actually increased that. I supported that. I think it's a good idea. The more information you have, the better. The lenders can look at an individual and assess that risk and give people more access to credit. It's very important. So at the end of the day, it's behoving to the lenders to be able to get as much information as possible. And it's behooving to the private sector folks, because they're in competition against each other, believe it or not, they are in competition, because lenders pick and choose which ones of these they want, to be able to get as much information as possible and who can be more predictive about the ability of somebody to pay back that loan. That is a really, really important thing, and I think we're missing the point. We're sitting here looking at the individual. The reason the individual wants this information out there is so they have access to credit, and we've forgotten all about that. When you give that information to the government to allow them to oversee all this, you've just opened a whole nother can of worms, and I think you really have denigrated the individual's ability to get access to credit. With that, I see my time's up. I yield back.
Gentleman yields back. Gentleman from California, Mr. Sherman, who is the chair of the Subcommittee on Investor Protection, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I join with Mr. Lukemeyer, at least in being a bit concerned about a federal reporting, credit reporting agency. That concern is borne in part by my former chairmanship of the Asia Subcommittee, where we see the Communist government of China creating a social credit score based on politics. As much as I fear and I'm concerned about what the credit rating agencies can do to consumers, I'm even more concerned about what the government can do. I'm also concerned about any bill that would take a system where the banks pay and instead provide the service for free or at the cost of taxpayers. We in Congress and the federal government have had an eviction moratorium. So people who couldn't pay their rent didn't, and thank God they're not homeless. Mr. Ejaz, are these people going to have terrible credit rating, credit reports because our landlords reporting their failure to pay rent in a way that hurts their credit score?
Thank you so much for your question. And for part of my answer, I will defer to Chi-Chi Wu for this, but we at Consumer Reports are concerned that when the relief that was passed with the CARES Act and all the policies that were passed in order to address consumer concerns during COVID-19, that when those expire, consumers' credit reports may be affected significantly. Chi actually, and I will pass it to her, she called this the pandemic paradox, where scores have somewhat stayed afloat throughout COVID-19, but once relief expires for folks, we'll start seeing the impact on folks' credit reports, and it's best to get ahead of that as we can.
I've put forward proposed provisions that we have not passed to say that those who couldn't pay because of COVID should not have their credit scores reduced. And I think that we do need to revisit that. But I want to go on to another question, and that is, we have this recent lawsuit against Transunion, inaccurately reporting that certain individuals are on the Office of Foreign Asset Control Specially Designated Nationals and Blocked Persons list. It's usually called the terrorist watch list. Now, it's one thing when a credit rating agency says, I didn't pay a medical bill. Okay, they may get confused. They may make a mistake. Things happen. But when you say that somebody's, and you incorrectly report that they're on the terrorist watch list, that's a much bigger deal. Unfortunately, the court threw out the lawsuit claiming that only plaintiffs concretely harmed by the defendant's statutory violation have Article 3 standing. And of course, many in the class did have that concrete harm, but many of others that were in the class did not. Ms. Wu, did Transunion violate the Fair Credit Reporting Act by stating that Mr. Ramirez was on the terrorist watch list?
Absolutely, Transunion did. They failed to use reasonable procedures by tagging an innocent man as a potential terrorist. But the Supreme Court said even though Transunion violated the Fair Credit Reporting Act, those consumers where the information wasn't shown to a third party couldn't even get through the courthouse doors. And this was a California lawsuit. And so that's why we think Congress needs to provide for injunctive relief, because the court did say if there's injunctive relief, that might be a way to get through the courthouse doors.
So the court said that if they had put you on, they had added something erroneous to your report, but nobody had seen it, that then therefore you couldn't have a day in court? Or
That's correct.
Okay, so
That's correct. You could get it and you could panic, say, oh my God, they think I'm a terrorist.
Right.
No remedy.
No remedy for the psychological harm unless there is in fact defamation communicated to the party.
That's correct.
Again, if this was accusing people of not paying a medical bill, it's one thing. The terrorist list, you've got to be a lot more careful. And I should point out that people of certain ethnic and religious groups are people who are going to have the names that are going to be on the list. So this did not affect people randomly in our society. This affected anybody who has a name that's similar to another name. And
the gentleman's time has expired.
I yield back.
Gentleman yields back. The gentleman from Michigan, Mr. Huizinga, is recognized for 5 minutes.
Thank you, Mr. Chairman. Appreciate it. Mr. Quan, I'm just wondering, can you give us a sense of overall trend of credit scores, especially during the pandemic? What happened?
Thank you, Congressman. So overall, I think the TransUnion, Experian has reported overall during the pandemic, because of all the CARES Act interventions, consumers' credit score actually has increased slightly by, I think, 7 points.
So, okay, so we didn't see it erode. We actually potentially saw it increase a bit, correct?
Correct. And also we have seen some kind of deleveraging, especially in credit card debt. So people are paying off their debt because of the government assistance.
And some would maybe argue and point out limited opportunities to go out and actually spend money on anything. I think a lot of us were a little frustrated with that as well. So obviously lots of calls for a government-run credit reporting bureau that somehow would increase competition and accountability. I mean, what's your take on that? Does it actually increase accountability and increase competition? I think that's one of the more bizarre claims.
No, I mean, in terms of competition, no, there's not going to be any increase in competition, and it's actually more likely competition will be reduced to zero. Again, as I said in my written testimony and also in my oral statement, the private sector, they have problems, of course, but they actually have this profit motive, so that if they don't treat the customers better, somebody else may do a better job. The customers will go somewhere else. And the lenders need accurate information. So it is not in anyone's interest to have inaccurate information. So when you have a government bureau, there will be no competition because they are backed by unlimited tax revenue, and private sector cannot compete.
Yeah, and obviously nobody wants inaccurate information. I found it fascinating, my predecessor's questioning about the no-fly list and the terrorist watch list. Apparently, those on the other side had no qualms about having people on that when it was time to go purchase a weapon, for example. That seemed to go out the window, but as long as it was dealing with credit, now suddenly they're very interested about who's getting on that, falsely getting on that watch list. But Mr. Quan, predictive data assists lenders in providing borrowers with access to affordable credit. And I'm curious if you would discuss the consequences of consumers to consumers if risk-based pricing system was rejected.
Oh, that would be a disastrous outcome for every consumer, not just the low-income consumers who have difficulty in accessing credit. So risk-based pricing, basically what it means is the lenders allocate or make decisions on credit based on the risks they perceive. And this is how private sector works. If you high risk, that means you probably have a lower chance of paying me back. That's why, as an investor, as a lender, I'm going to have to charge you a higher rate for compensate for the risk I'm taking. And if we get rid of risk-based pricing, what's going to happen is lenders will have no incentive or interest in treating anyone who has a more means to pay back or more willingness to pay back. Then everybody will get charge the same price.
Yeah.
At the end of the day, what we see is lower availability of credit and a higher cost of credit for everybody.
And let's take it one more step. Okay, what about the regulators who go into those lenders and have to look at the quality of their lending to determine whether they are in compliance or not? Right? Has anybody looked at the effects that might have?
Well, that's a great point. So I look at student loan lending, right? The federal government hands out loans to anyone without even questioning whether they will have the ability to pay back. So the federal government essentially is the biggest subprime lender in this country. If the federal government was supervised by the OCC or the FDIC or the Fed, they will fail the safety and soundness exam miserably.
In my last 30 seconds here, do you have any confidence that the federal government's going to be able to keep all this data secure? We saw a Securities and Exchange Commission had a breach. They're now building the consolidated audit trail, which is going to hold all of our personal identifiable information. There's a lot of people on both the left and the right who have previously expressed doubt about the security of this information all being in one spot, basically one big giant vault, which becomes a target. So just give me your last seconds on that.
You said it very well. I have no confidence whatsoever.
Okay, I think my time has expired and I yield back.
Gentleman yields back. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the subcommittee on housing, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. Mr. Ejaz, if given the choice, would you choose KU or MU?
Excellent question. I would choose MU any day.
I know it's a difficult question, but I had to ask it.
Thank you.
There are a lot of scoring models that use statistical analysis to assign a score to a person. There's one particular company used 50 versions of a score for a person that can be sent to lenders. Does that make any sense at all? 50 different versions?
Thank you for your question. It's true. There's so many different credit scores that any one person can have. The reason for this is because lending product categories can differ, and the private sector believes that different scores should be applied for different types of products. But it is true that the credit score that quote unquote I think is in most people's head is more of an approximation of what the variety of your credit scores say, as opposed to being your true credit score.
So what is the logical reason, this is any logical reason, that we don't have a uniform system of measuring creditworthiness?
That's a great question, if I may, Congressman. It confuses, it's for sure confuses consumers that there are so many different kinds of scores out there. You've got FICO, you've got Vantage, you've got different generations, different product types. One thing a public credit registry option could do is give a standard score so that consumers know where they stand. And it gets even worse because the credit bureaus also sell these FACO scores that no lenders use. And people get confused. They think they have one score, they go to buy a car, their car loan rate is different. So certainly something a public credit registry could do is standardize it so there's more clarity.
Anybody else? Okay, that's fine. I want to move over to credit invisibility to find out if there is anything that you would recommend to this committee that we needed to do to help, bring credit invisible individuals into the scoring system, whatever, although it's messed up too. But what would you recommend? Anyone have recommendations?
Congressman,
If I may, Congressman, I think the thing that's been hammered on is consumer choice. One of the most important things about credit invisibility is consumers should have the choice to be able to supply their rental, cell phone payments, bank account histories, because the system for too long has stripped consumers of the ability to make the decision. The consumer should have the choice. Alternative data can be helpful, but it can be harmful. We have to proceed with caution. Some of the most promising data, and here's where, for example, Mr. Quan and I agree, is bank account transaction data, because it can show ability to repay. It has shorter time frames, so you're not locked into that 7 years for bad credit information. And so one important thing is to give consumers control and the ability to share that when they want to, but turn it off when they don't.
And Congressman Cleaver, if I may jump in here, I 100% agree with Chi on this issue. I think it's really about consumers' control. So that's why I think it's very important that we have a functional open banking system in the United States where consumers are in the center of the data flow, so they can consent, they can permit any third party that wants to have access to their data, so they know exactly who is using their data, how long it's going to be there, and for what purposes. So all the innovations in the private sector regarding using cash flow data, using bank transaction data, it is already happening. It is already happening. But the key thing is really about having a good rule of the road, which again I'm mentioning the Cfpb here. They have the task ahead of them to write a pro-consumer, pro-innovation, open access 1033 rule. Thank you.
Thank you. Are you back, Mr. Chairman?
Gentleman's time has expired. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Quan, I think you stated it well that the impact of eliminating risk-based pricing would have a very negative impact on low and middle income borrowers. It would eliminate access to credit and drive up the cost of credit. A recent study from the United States Chamber of Commerce corroborates your testimony and found that eliminating risk-based pricing and replacing it with a uniform pricing model would raise prices on consumers and limit the availability of credit and other financial services, especially to low and middle income borrowers. And that makes sense, right? If lenders can't accurately predict a borrower's ability to repay, they need to raise prices or limit options to account for the increased uncertainty. A prohibition on using predictive data would not make the system more equitable, but would instead dramatically exacerbate inequalities that the authors of these bills say that they want to fix. Speaking of inequalities, Mr. Quan, are you aware of any of the three major private credit reporting bureaus using race-conscious criteria?
No, I'm not aware of.
To your knowledge, and is there any evidence to the contrary that these credit reporting bureaus use only race-neutral criteria, payment history and the like?
That is my understanding, sir.
And yet, one of the majority's witnesses says that the current system of private credit reporting bureaus is plagued with, quote, systemic racial inequity. Let me ask you this question, Mr. Quan. How would excluding certain predictive credit data from credit reports harm a low-income but financially responsible African-American consumer with a high credit score?
Well, so you really touched a very important point. And I think, I would also give the credit to the other witnesses for really highlighting the important fact that a lot of Americans, especially people of color, have challenged in getting into the mainstream credit system. That is because you have to have credit in order to build credit. If you don't have credit, how can you build credit? So that's why it's important to have this new source of data, payment data, alternative data, rent payments, utility payments, for the lenders, available to lenders to use to bring access of credit to these people.
Well, I mean, my point is whether you're white or black, Hispanic, whatever your racial minority is, if these credit bureaus are using race-neutral criteria, and maybe you are a low-income individual, but if you pay back your bills and you have a positive credit score, a positive credit history, your credit score is going to be higher. And if you eliminate the risk-based pricing, the cost of credit is going to go up, and that's going to harm that borrower regardless of their racial profile. Is that correct?
That's absolutely right. Correct. So it doesn't really matter what your color of the skin is, what religion you believe in. If you can pay back the loans, your score will go up. If you pay back the loans on time.
Thank you, Mr. Quan. Let me ask you about this National Credit Bureau idea. We've talked about it ad nauseum here, but what incentives does a private credit reporting agency have in competition with other private credit reporting agencies to get credit data accurate and get it right?
If the credit bureau cannot provide accurate data to lenders, lenders will stop using their services, period. Because what lenders want is really accurate data for them to make better lending decisions. So there is a natural competition among three bureaus to make sure the data is accurate.
And Mr. Quan, what incentives would a single government bureaucracy have to fix errors?
Well, so I wouldn't even call it an incentive. It's just their ability, whatever, I'm not a technologist here. So whatever best methods available to the private sector, the government can use that too. So there's no reason for me to believe the government is able to do a better job in improving accuracy, if we believe accuracy is a big issue today.
And let's just, one final question on this alternative data issue. Obviously, utilization of alternative data by these private credit reporting agencies is helping Americans gain access to credit. But I think I heard one of the other witnesses say that positive data should be reported, but not negative data reported. How would that impact the cost of credit if the data was only selective in that way? If
we believe accuracy is important, accuracy means complete data, whether it's positive or negative. If you specifically ignore negative data, that is not accurate. So we have to make sure we have accurate and complete data available for lenders.
Thank you. I yield back.
Gentleman's time has expired. The gentlewoman from Ohio, Ms. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is recognized for 5 minutes. I think she just exited. Let's, how about Mr. We will go to Ms. Beatty in a few minutes. The gentleman from Illinois, Mr. Foster, is now recognized for 5 minutes.
Thank you, Mr. Chair. Your credit score is often one of the most important metrics affecting how you interact with the financial services industry, and particularly with respect to housing, which is a basic human need. Your credit score affects your ability to rent or own a home. It determines whether or not you can finance a car, and is even examined by the state bar associations when law school graduates apply to become attorneys. So despite the obvious great importance of your credit scores, a Consumer Report survey indicates 34% of Americans report finding errors in their credit profile. The consumer data industry, however, claims that figure to be false and boasts a 98% accuracy rate. However, the studies cited by the CDIA, conducted by the FTC and the Policy and Economic Research Council, seem to indicate 23.9% and 19.1% error rates respectively. And so there's some significant disagreements over these accuracy figures. And so I was wondering if anyone can speak on what really the best knowledge is on that.
I'm happy to take that. And thank you. Yes, I can start with it. And thank you for your question. The PERC study was done in 2011 as well. The FTC study that we cited today, the panel cited today, was done in 2012. And I absolutely joined Mr. Quan in asking the FTC to take another look at this. Our report with Consumer Reports, we put out a survey that volunteers could fill out, and yes, 34% found at least one type of error. And so I still think that despite those other two studies being almost 10 years ago, that there's still indication of many, many problems. And I'm sure Chi-Chi can say more.
Yeah, if I could just make 2 points about these accuracy studies. Number one, whether it be 2% or 20%, when you talk about 200 million files, that's millions of people affected. So even 2% would be 4 million people. The FTC found 5%, that's 10 million. I agree another study done by the FTC would be helpful, but we need reform now. The FTC study actually took almost 10 years because it was so complicated and they wanted to do it right and systematically and rigorously. We can't wait 10 years for reform. American consumers can't spend the next 10 years continuing to be abused by the credit bureaus.
Thank you. And now, when you look over the different types of errors that have, one of the most common seems to be simply identity errors, where you're getting the wrong information or the right information about the wrong person. For example, the Equifax website has a FAQ page called "What Can I Do If I Believe My Credit File is Mixed Up with Someone Else's?" Which leads me to believe, as well as hearing from my constituents, that identity errors. Now, some states are rolling out what many people feel will be transformative to eliminating not only identity errors, but also identity fraud, which is these mobile IDs, mobile driver's licenses sometimes, which allow you to download the information on your Real ID compliant driver's license onto your cell phone and authenticate yourself online for any transaction. And if we had a high quality way of authenticating yourself, when you enter into a contract, when you successfully pay, when you start a bank account, what fraction of the errors would go away if we had a high quality digital ID in this country? Does anyone have a feeling for that?
So the issue with the credit bureaus and mixed files isn't just about what kind of identity, it's matching. It's how you make sure A matches to B. And the problem with the credit bureaus is their matching criteria is overly loose. So social security numbers are unique identifiers, but the credit bureaus use only 7 out of 9 digits and they use a partial match of name and a partial match of address. So that's how they identified two different people mixed up. You can have the most rigorous identification, but if you make your criteria too loose, you're going to mix people up, and they make the criteria too loose deliberately because that's what lenders want. They'd rather have false positives than false negatives. It's all about the incentives, and that's why it's important to have reform and a public credit registry option.
Yeah, well, I think that what you really want here is accuracy. And if you look at countries like Estonia that have a high-quality, secure, privacy-preserving digital ID, these problems largely disappear. And I think that we should join the states that are rolling out these advanced identity products, also rolled out recently by Apple and Google Android, as something that they will support, that this could be transformative, at least in eliminating this class of identity errors from messing up people's credit rating. And I hear the gravel and yield back.
Gentleman's time has expired. The gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Mr. Chairman. I got bad news for everybody in here. I'm a car dealer. I'm a borrower. I'm a lender. And I use risk-based pricing every single day. Making sure that we have a complete and accurate picture of an individual credit history allows us to offer the best rates possible to our customers. If we begin to hide information like we're talking about today, lenders like myself are forced to price in this additional uncertainty that we might not get a return on our capital, and the price of credit will go up for everybody. Now, bottom line is, if you pay your bills, you got a good credit rating. If you don't pay your bills, you don't have a good credit rating. I listened to Ms. Wu. She said in 50 years, people have been abused. I've been in business 51 years, and I've never abused anybody. So I thank everybody for coming here today. Now, the response of my Democratic colleagues to problems that have within the big three credit reporting bureaus is to centralize power and to create a public option within the CFPB. This belief that the federal government could somehow run a credit reporting agency more effectively and efficiently than the private sector is garbage. It's ridiculous. It's the post office. It's Amtrak. It's SBA. Not only will you force consumers to hand over all their data to the federal government, but it will also remove all incentives for the private sector to innovate and come up with new models that will better predict the creditworthiness of borrowers. So, Mr. Quan, quickly, can you discuss how the incentive structure we talked about today to compete and innovate would change for the private credit bureaus if a public option is created?
Thank you, Congressman Williams. So you're absolutely right. So when the government takes over, there will be no incentive whatsoever for the private sector to compete with the government. They cannot. And to come up with better ways, more innovations, because government, again, monopolizes credit reporting, and there will be no competition, there will be no innovation whatsoever.
And with no competition, the consumer is
Worse off.
put in a bad position. If making it harder for the private sector to compete wasn't bad enough, placing this new public credit reporting agency within the CFPB is also extremely problematic, and it's just a ridiculous idea. Since its inception, my Republican colleagues and I have been pushing to reform this rogue agency and make it more accountable, whether it's creating a bipartisan board so the CFPB is not run by a single director, providing greater clarity to their enforcement capabilities so the business is not penalized for practices that were never previously identified as illegal, or bringing the agency under the normal appropriations process. All of these reforms have been blocked by the Democrats, which ensures that this agency will operate on a partisan basis for the foreseeable future. If the Democrats' proposal were to be signed into law and public options created within the CFPB, I'm concerned the new agency would be hijacked for partisan political objectives, such as removing all student loan information or unpaid medical debt from credit reports. I mean, you go borrow the money, shouldn't you pay it back, for crying out loud? You tell the person, I'm going to pay you back, but you don't want to pay it back. So, Mr. Quan, given the discretion that the CFPB currently operates under, how would it be possible to ensure that this new public option would not be used for political purposes rather than working to ensure lenders are provided with the best information available as they attempt to accurately price risk and give the customer the best price?
Thank you, Congressman, for the question. I think it's best in the current system that lenders make the choice, make the decision who they want to lend money to and how for at what cost. Assuming, of course, we have to make sure they follow the Equal Credit Opportunity Act. So if we let the government dictate who they should lend to, At best, the criteria for underwriting will be influenced by the administration, whether it's Republican or Democrat. At worst, the federal government is deciding who is creditworthy. I think this is the worst outcome. We have the government decide who is worth of credit. And the private market is the best way to allocate credit, not the government. Thank you.
Well, in the end, the private sector will get it done better. The government will pick winners and losers. They do every single day, and it will trickle down into less product, higher prices for the consumer, and it will also go to less employees. And again, the government control will be putting a stick in the economy. So private sector is much better. I'll yield my time back. Thank you.
Thank you. The gentlewoman from Ohio, Mrs. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you to the witnesses and to my colleagues. We've heard a lot today about credit unions and who's affected by credit reports and the data that's collected. The Consumer Financial Protection Bureau issued a report in 2014 entitled Consumer Credits Reports, a study of medical and non-medical collections. In that report, the Cfpb found that over 50% of credit reports that had collections were related to medical collections. We've also heard that most of those dollar amounts were somewhere around $200, and the highest was all under $490. We also noticed that a company called NerdWallet compiled data from all of the Medicare compliance reviews of the United States hospitals conducted by the Office of the Inspector General. And we found that almost 50% of Medicare medical claims contain medical errors that resulted in an overpayment to something like 26, 27%. We've also heard that some individuals have said those numbers were closer to 70 or 80%. So Ms. Wu, with a system of errors rates for medical debt so high, could you tell us, could the argument be made that it's not beneficial to include these debts at all in credit scores?
Thank you for the question, Congresswoman. And absolutely, yes, the argument could be made. Medical debt for medically necessary services should not mess up anyone's credit report. People get sick. It's not under their control. It's bad enough we have a healthcare system where people go into unmanageable debt just to stay alive and stay healthy. For it to mess up their credit reports is unconscionable.
Thank you. I'm also chair of the Subcommittee on Diversity and Inclusion, and I've spent the last 2 years advocating for companies to diversify their workforces and their senior leadership. When I look at the 3 credit reporting agencies, they're a perfect example of why this work is so important. So Mr. Greer and Mr. Traub, I'm going to ask you this question. When I look at Transunion and I look only 9% of their senior leaders and 10% of their board are underrepresented minorities, 30% are women. We can keep going with Equifax, Experian, all the same. Even with Experian, astonishingly, they virtually have no racial diversity on their boards or in their senior leadership. Several of our witnesses have discussed the inherent inequities that exist in the current credit reporting system. Do you believe that the makeup of the leaders of these companies has a direct effect on the inherent inequities in the credit reporting system? Mr. Greer?
Yes, thank you, Congresswoman Beatty. Absolutely do. All this conversation about accountability has been, who's more accountable to who. I will say this, I've been called naive many times in my life. My son calls me naive all the time. But I would rather have this body hold some institution accountable, meaning the folks in this dais up here, because the folks in this dais more reflect the population of the people who are consumers in our marketplace than the shareholders and the people that run these companies. Nearly 90% of shareholders across our economy are white. And I haven't looked at the Equifax, Transunion, and Experience shareholders, but my guess is that it reflects that number. So like I said, when we talk about accountability, the folks in this room are more accountable to the consumers that are impacted by these companies than the companies are themselves.
Okay. Thank you. I think I only have 30 seconds, so let me go to Ms. Wu. Can you explain to this committee why it's important to include a credit score with the annual credit report?
Yeah, consumers should have free access to free annual credit score so they can see their standing, so that if they want to, get a credit card, buy a car, get a mortgage, or even rent an apartment, because landlords use them, they know where they stand.
Thank you. I've introduced a free credit score and consumer act, which is also in this comprehensive credit. So thank you. And I yield back. My time is up.
Thank you very much. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Chair Waters. Thanks for convening this hearing. Thank you for our panel's participation, both in person, delighted to be in person, and online as well. And thanks for talking about the importance of the credit system and how that's benefited millions and millions of Americans over the past several decades to have more access to credit, more opportunity to fulfill their lives with a home or a car or something that they need to benefit themselves. So our credit system is fundamental to our households having access to the credit they need for their future. Mr. Quan, have credit score reports helped more families have access to credit?
The answer is yes.
Have credit score reports helped community banks avoid credit losses by adding them into their underwriting process?
The answer is absolutely yes.
So do you support the concept of consumers offering more additional data? I don't ever use the word. I'm like Mr. Green of Texas. I don't use the word alternative data. I like the word additional data. So Mr. Quan, do you support the concept of consumers offering additional data in order to strengthen their credit report, say their telecommunications or cable or rent or utility bills?
Absolutely, yes.
So, the past two Congresses, Keith Ellison, now the great consumer advocate and attorney general for Minnesota, and a former member of this committee, Keith Ellison and I had that exact bill for Congresses. It was a bipartisan bill that was called the Credit Access and Inclusion Act. And I still promote it, I still introduce it, I still support it. It has no bipartisan support like it did in previous Congresses. In fact, it passed the House floor, I think, on the suspension calendar. And it allows a consumer to add their utility payment or rental payments as a way to boost their credit score. Have you had a chance to look at that bill in the past, Mr. Quan?
Yes, I have.
So is that headed in the right direction?
I think from policy's perspective, the answer is yes. But however, Congressman Hill, I also want to remind you that the private sector is already innovating. So they are, some lenders, and mostly venture-backed, they are incorporating on-time payments of streaming services, telcos, rent in their underwriting system so that more consumers can qualify for better rates.
So you're saying the private sector is innovating and actually offering that as a way for people to have higher credit scores and more credit availability?
That's correct.
Wow, gosh, that's good to hear. Well, I think it's a good idea. It was a bipartisan idea. I hope it'll be a bipartisan idea in this Congress as we proceed. So the flip side of this, some of my friends on the other side of the aisle in this Congress, while they like the idea of additional data helping consumers, they've argued quite vociferously that what I think is an economically illiterate concept, that actually government should prohibit negative history on credit reports. Should the government say that reporters cannot give us negative credit report, Mr. Quan?
Well, maybe to answer the question another way, we all heard this term Gpa inflation, right? So if everybody gets a 4.0 in their GPA, everybody gets perfect on its SAT score, how will schools decide who they should admit? And this is the same thing here. If we suppress all the negative information in consumers' reports, everybody gets 150 FICO score, and FICO score will be useless. No lender will use that information whatsoever. We're going back to,
In the long run, that strikes me that would mean that lenders would make mistakes and lend money to people that possibly couldn't pay it back, and then they would have a credit default, and then their credit score would go down if people had misleading credit scores. Isn't that a possibility?
Absolutely, you're absolutely right.
So in the long run, I think an idea like that really hurts consumers and households, reduces access to credit, possibly raises the cost of credit. Could it also harm community banks that don't have fancy upscale consumer underwriting systems like JP Morgan Chase? Could that hurt the banks if they had a false reading on a credit score when they offer consumers credit?
It will not only hurt consumers, but also this is going to have safety soundness concerns. The banks cannot really issue or loan out high quality loans. Then the OCC, the prudential regulators will have concerns.
Thank you. Well, I appreciate your time. We're for safety and soundness of our banks on this committee, and I yield back.
Thank you. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you very much, Madam Chair. I really appreciate you bringing this issue before us. I especially appreciate all the witnesses today. Consumers have to have more control over their data because consumers are not the customers, as has been said here today. The interests are not really aligned with credit reporting industry. Mr. Quan said that you need to trust the customers better. You need to treat them better or they're going to go elsewhere. The problem is that the consumers are not the customers of the credit reporting agencies. That's not the case here. That's why these interests are not aligned. Now, I wish we could get to a bipartisan solution. I do think that this begs for a bipartisan solution, but it's been very difficult, I think, because so many of my colleagues and friends on the other side have really been radicalized over these last few years. They attack the government and they point out every wrong thing that the government does. And of course, everyone makes mistakes. The government does too. But they attack it vociferously and anxiously and really sometimes heartlessly. But it's interesting. The Social Security Administration has all of our Social Security numbers. In fact, it's had mine since birth. And to my understanding, they've never had a breach and they've held it very securely as they have yours. Now, I could be wrong about that. There's been a breach, but I don't think there has been. Not that I'm aware of. So it is sad that we can't get to a bipartisan solution. And I do think that this begs for it. But again, the radicalization that I see on the other side, they keep calling everything socialism, communism, or whatever. In fact, recently, one of the saddest things I've seen in politics, we have a very well-decorated military officer, the chairman of the Joint Chiefs of Staff, General Miley, called by the leading political commentator on the right a pig and stupid just because he's an intellectual. And what do I hear from my friends on the other side about this? Nothing. Silence. This would have never happened 10 years ago, and it certainly wouldn't have happened when Ronald Reagan was in office, I can tell you. That's why it's harder and harder to get the bipartisan. They think we're radicalized. We're not. They are. And they have to change, and I hope they do. Now, they also seem to overlook some of the data breaches. So I looked up, just a very quick Google search, the biggest data breaches of the 21st century. Zynga, 218 million users' accounts were breached. Yahoo, over 3 billion. NetEase, 235 million user accounts. MySpace, 360 million. MyFitnessPal, 150 million. Marriott International, 500 million. LinkedIn, 165 million. Heartland Payment Systems, 134 million. Dubsmash, 162 million. And of course, Equifax, 147 million customers. They seem to overlook that and say the federal government's terrible, they can't do this. But they overlook the facts of all these breaches. So I wish, again, that we could get to a bipartisan solution. Maybe we can. They shouldn't be so radicalized. Now, Mr. Greer, you previously stated, according to the Consumer Financial Protection Bureau, about 15% of Black and Latino customers are considered credit invisible with no tractable credit recording. So what additional information or alternative data or additional data should be collected for these individuals to have a more ample report, a better report that really treats them holistically? Mr. Greer.
Thank you for that, Congressman Vargas. Yes, and some of it I talked about in the testimony, where things that are painting the fuller picture of their financial lives, things that they pay bills on regularly, and we're not talking about taking data out. We're talking about adding data, like cell phone payments, utility payments, rental payments, and again, the ability to opt into doing that. The other thing is, I think we need to reckon that people of color, Black and Latino, particularly immigrant populations, cannot access credit markets. And if the credit bureaus continue to weight current credit held as something that drives credit decisions, we Black and brown communities are always going to be behind, because we've been systematically held out of accessing credit, which this committee has dealt with for a long time and continues to deal with.
Well, thank you. And again, I hope we do get to a bipartisan solution, but the fever has to break on the other side, and I hope it happens soon. I yield back.
Thank you. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Thank you, Madam Chair. I appreciate everybody on the panel here for this discussion. It seems that this is a discussion that we quite often have, and is something that I think we do need a bipartisan solution. And what my good friend Representative Hill proposed in the past, I think, is a good starting point if we could get some buy-in from some of the members on the other side of the aisle here, as we once did. One of the bills that included for discussion in this hearing, to me, is incredibly troubling, and it is the one that's been discussed here, is creating another government entity, one that would be a government-run credit bureau. The problem is, I think this is based on the false assumption that the government would do a better job of handling consumer data and credit reports than the private sector does. We're in a period right now where the approval and trust of government is at an all-time low. The American people do not trust their government. They do not think the government operates in their best interest. And in fact, a record number of people believe that the government has already too much control over their lives. Now, adding another entity of government with even more control over their lives would be counterproductive, in my opinion, and the opinion of many of Americans. If you think that consumers are frustrated with credit bureaus now, I can only imagine if every American had to deal with a bureaucracy equivalent to the IRS, which has the lowest approval rating of all government. In fact, if you remember, the IRS, while it does have some accountability supposedly to this chamber, to Congress, engaged in targeting a certain group of people with audits just a few years ago. So clearly, government doesn't always operate in this vacuum where it doesn't consider politics. In fact, politics becomes a very important part of government. Every time someone would need to borrow money, apply for a job, or rent an apartment, they would wait on the federal government to respond. If you think that is a good solution, look at the Veterans Administration right now and how well they service our veterans with the backlog that they have. I think this is a ridiculous solution to a problem. I think that it's been brought up with the cybersecurity issues, and yes, virtually every federal agency has experienced a significant data breach. If you look at how much of our data is spread out across various government agencies, we don't even have federal standards for data privacy. But yet we want to expand the operation of government. I think that's a bad situation. Mr. Quan, can you elaborate on why the private sector, while not perfect, is so much better equipped to handle and improve consumer reports than the government is?
Thank you, Congressman, for the question. So as I've mentioned before, the best way to achieve equity in credit access is through innovation and also a conducive environment where innovation can flourish. So the private sector is already coming up with solutions to address the problem. The Public Credit Bureau doesn't add any value to it because everything in the proposal about allowing consumers to use more data to be used in credit scoring system is already happening. We do not need the government to do the job the private sector is already doing. The private sector is already innovating to allow more consumers to get access to credit.
I want to ask another question. It's been asked in a different way, but Mr. Quan, would removing negative but accurate information from consumer credit reports increase costs and reduce access to credit across the board?
That's absolutely right, because at the end of the day, what we want is accurate and complete information. Accurate means if it's a positive, it should be there. If it's a negative, it should also be there. When we have that kind of information, it's best for the lenders to make the right decisions. At the end of the day, the cost of credit will go down and the availability of credit will go up.
Mr. Quan, I do think that some improvements should be made to the system, such as adopting alternative data and updating credit files more promptly. Can you comment on those proposals?
Absolutely. I think, sometimes consumers see an error in the reports where they already paid off the debt, but it has not been reflected in their credit score or in their credit report. That's because furnishers are not really sending out the real-time information or as frequently as they should be. So there is, again, I would say innovation can play a role here. So if the furnishers can more frequently report the data, then the information for the consumer can be more real-time, or as close to real-time as possible.
Oh, thank you. I yield back.
The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Thank you, Madam Chair, and I would like to welcome all of the ones who are testifying here on the committee. This is a very important subject that we are on, especially in dealing with consumer credit and how it affects people who apply for jobs in order for them to get jobs. But Traub, in your testimony before the Colorado Senate Judiciary Committee in 2012, you stated that 6 out of every 10 American employers now look at job application credit reports when hiring some of all positions. Employment credit checks have become commonplace among employers who are looking for ways to predict if a candidate is honest, their ability to manage money responsibly, and if they are likely to steal. In your research, have you found any evidence of this validity of this practice before the prevalence of using credit reports in hiring decisions? If no, what are the harms to the continued use of credit checks in employment?
Thank you, Congressman. I'm aware of no proven link between personal credit reports and either someone's performance of a specific job or criminal behavior. In fact, a spokesperson from Transunion admitted, we don't have any research to show any statistical correlation between what's in somebody's credit report and their job performance or their likelihood to commit fraud. And yet we still see a lot of employers, many employers across the country, using credit checks as part of their hiring screening process. To answer your question about the harms of this practice, the harm is that job applicants can be rejected for jobs that they're very highly qualified for. And this is a loss for employers who might be missing out on really excellent employees because they're screening for a factor that's irrelevant. And also a huge loss for job seekers who might be able to pay off their bills, in fact, if they were able to secure work. So in this study you referenced that I conducted for DEMOS, we found that 1 in 10 survey respondents who were unemployed had been informed they would not be hired for a job because of information in their credit report. And we know that as a result of discriminatory policy, Black and Latinx consumers are more likely to have poor credit, as we've been discussing, than white consumers. So checking credit history can just become another covert and perhaps unintentional means of racial discrimination in hiring, compounding discrimination that happens in lending. There's also harm, actually, when employers sometimes will say, oh, well, we asked people to explain the source of the bad credit. We let them explain that. Well, medical debt is a major cause of flawed credit, as we've heard today. No one should have to explain the details of their cancer treatment or their child's struggle with drug abuse to get a job. That's not relevant. Similarly, divorce and domestic abuse are closely connected with flawed credit. These are also matters that job seekers shouldn't have to expose to a potential employer just to get a job.
Well, it's very interesting, and the bill that I filed, HR 4114, that deal with these restrictions, and really I think it's a bipartisan bill because what you just said is really is not beneficial in determining whether it's going to be a person's job performance. As a little bit of follow-up, this restricting credit check for Employment Decision Act is a part of Ms. Presley's comprehensive package. The bill simply cracked down on companies using reports when they hire new employees. There are 2 exemptions for national security purposes and an instance where credit checks are required by local, state, and federal law. Bad credit does not always correlate, as you state in your statement, the proof of job performance. We have all made poor financial decisions. I know I have before, and we need to stop punishing people and start helping people move forward. And I really think that this is a great thing to do. And I represent in a community too of a lot of students who comes out trying to get jobs and so forth and run into these type situations. And it really keeps them from doing what it's supposed. Well, my time is running out and I yield back.
The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
I thank the chairman. I thank our witnesses. I appreciate your attention to this matter. And frankly, I appreciate the majority for calling attention to the power credit reporting agencies have over our lives. I mean, I think rightly recognize the problems when credit reporting agency, whomever that is, can effectively block people from access to banking, access to credit, all kinds of things. And I think that's really why we should be especially cautious about giving even more power to the federal government. The federal government has not been a trustworthy wielder of its power. Historically, the government has used its power to engage in practices that are abusive. Things like redlining, where bank regulators have done that. Most recently, Operation Choke Point was kind of a different version of that. But sadly, there's a long history in our country of somebody saying, effectively, you're not going to bank those people, are you? Now, who those people are has changed over time, but we should be using the power of government to stop that, not enable it. And that's, I think, what would happen here. In fact, that is the goal of China's effort to use their power of their government to decide who gets credit. And in the opinion of their government, they're just making sure the right people get credit. But the reality is they're using it as a means of control. They're using their whole financial system as a means of control. And no more abusively than what they're doing to Uyghur populations, but they're doing it to anyone who would speak ill of the government or any of their leaders or who wouldn't comply with other norms. In fact, if they cross China's version of their woke heresy code, they're effectively canceled. And we read this in all sorts of dystopian futures where people that are on the wrong side of the power structure are denied access to the financial sector. And thankfully, FinTech is offering alternatives to more power for more government. FinTech is truly creating this with with payment systems, with cryptocurrencies, with distributed ledger technology in particular. It's also more secure. So I want to focus, Ms. Traub, in your testimony, you lay out the case for a public credit registry. You break your argument down into 7 supposed benefits that such a system would bring. One of them, you claim, is that the government would offer enhanced data security. You go on to state that, quote, Americans already trust their government with extensive personal financial information through the Internal Revenue System, which has a strong record of data security. Well, first of all, Americans don't really trust the IRS. I think that's a gross mischaracterization. In fact, if you don't trust them, you go to jail, so that's a bad system. And secondly, they've also been breached. So, Mr. Vargas, yes, they have been breached. Most recently for 720,000 taxpayers who had their Social Security numbers stolen by hackers. And that's without accounting for what's been compromised, but hasn't even yet been measured by the SolarWinds hack. And what we know is true blockchain enables a much more secure architecture. We know that our current cybersecurity systems are broken at the government level, at the private sector level, and reinforcing the same failed systems with more power for those that keep implementing them is inherently flawed. You know, Mr. Quan, I'm curious if you could comment on the dangers of this consolidation of reporting, maybe with respect to what China seeks to do and how fintech today offers alternatives. And I think before you answer, I guess if you could also comment on how the current system, in a way, is rightly criticized because we've privatized profits and have socialized risks. So some of the reforms on liability are important. So, Mr. Quan.
Thank you, Congressman. I think you're absolutely right in your statement that when we have a government-run credit bureau, consumers will surrender their rights to the government to decide who's worthy, who's credit-worthy, who can get access to credit. So this is really not a bad situation for anyone. So the best way is, as much flawed as we think the credit system today is, it is still best handled by the private sector. And I also want to mention, our system is not fundamentally broken. Otherwise, we would not have the most competitive and the largest credit market in the world. So let's reform the system.
Good points. My time's expired, and I think that's your point is well taken, and I yield.
The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and to Chairwoman Waters and the ranking member, thank you for hosting the hearing. Thank you to the witnesses as well. One of the common themes that we heard today is the incredible damage that inaccurate information can wreak on an individual's life, and that's why the Transunion case that we heard so much about is so disconcerting. Mr. Ejaz, according to the study that you conducted for Consumer Report, 34% of volunteers identified at least one error on their credit report. And per the Cfpb, of the nearly 300,000 credit reporting complaints they received in 2020, over 2/3 involved incorrect information on their credit report. So, Mr. Ejaz and then Mr. Greer, can each of you briefly describe the impact of inaccurate information on consumers' credit reports?
Sure thing, and thank you for your question. So inaccurate information on credit reports can do a variety of things for consumers. First, if it's inaccurate personal information, while it may or may not impact their credit score, it can make it difficult for consumers to verify their identity with credit reports. And in our survey, this is actually what we found. Around 10% of folks that filled out our survey said they found it to be difficult or very difficult to access their credit report. And that's because when you go to check your credit report, you have to verify your identity with the bureaus. And if the bureaus design security verification questions based off of the information that's on your report, If that information is inaccurate, those questions can be unanswerable, and that's what some folks had found. But even more serious than that are the 11% of folks, or of volunteers that filled out our survey that found account-related errors. These are errors that can impact your credit score. And as we've discussed at length today at the hearing, a low credit score can keep you not just from affordable credit, but also access to employment, affordable homeowners and auto insurance rates in some states, and housing. And I'm sure Mr. Greer can
So,
follow up.
Mr. Greer, you want to add to that?
Sure. Before I do, I do want to thank Congressman Davidson for acknowledging the harms that the federal government has done to Black and brown communities. You referenced redlining, but what I do want to know, and it's a difficult thing that we cope with, but what the government also did was it passed the Fair Housing Act because it has a role in protecting the rights of people. And I think the conversation today about the Bureau is a perspective that people have on the government's role in also protecting people's rights. As it relates to inaccurate information, I agree. I don't have a lot to add more than what the other witness said, other than that one thing I think is important to note is that communities of color often have fewer resources available to them to fight back against powerful corporations when it comes to setting the record straight on what's in their credit report. So I just want to acknowledge that, and that if we're talking about a system that is truly equitable, we're addressing the capacity challenges that communities of color face compared to others when disputing inaccuracies.
Okay, well, thank you. Thank both of you, which is why I proudly introduced HR 4113, Improving Credit Reporting for All Consumers Act. I think it would really help. So, Mr. Greer, what do you think should be done to ensure that consumers receive a resolution to errors or inaccuracies that they dispute?
I'm not going to spend a lot of time because I think Chi-Chi has some really good ideas, and Amy might as well. But I do think that there's some accountability for a real answer. It was referenced how long people might have to wait if the government were in charge. Well, people are waiting today a long time to get resolution on their credit disputes. So I'll just leave that and leave it to other witnesses that may want to weigh in on that.
Okay.
If I may,
Yes, go ahead.
Thank you, Congresswoman. Thank you for the question. The credit reporting dispute system is broken. It's biased. It automatically rules in favor of creditors and debt collectors when there's a dispute. Consumers need a right of appeal. They need a higher power to go to when they can't get relief for errors. What your bill does is a wonderful idea of creating a right of appeal within the credit bureau as an independent unit so that consumers, when they're not satisfied, it also provides for injunctive relief. As I said earlier, that would allow them to go through the courthouse doors and ask a judge, please order the credit bureau to fix that report, fix my report.
Thank you very much. And Mr. Chair, I'm going to yield back. We've got 10 seconds, and I'll just pass that on to the next person. Thank you.
The gentleman from West Virginia, Mr. Mooney, is now recognized for 5 minutes.
Thank you, Mr. Chairman. For Mr. Quan, well, first, I'd like to address a proposal from the Democrats to create this government-run consumer credit agency under the Cfpb, Consumer Finance Protection Bureau, an organization which has many challenges of its own, including its very existence. I have a long list of concerns with a government-run consumer credit agency. If this proposal were enacted, the federal government would be responsible for keeping records of billions of consumer transactions. That's an enormous responsibility. So, Mr. Quan, you outlined concerns with putting so much sensitive personal information in the hands of one government entity in your testimony. Can you talk about the risk of cyber attacks associated with having one sole public credit reporting agency?
Thank you, Congressman, for the question. You're absolutely right. So Transunion has about 3.1 billion trade lines in their database. And so the other two agencies probably have similar number of trade lines. So this new government agency will house all these trade lines, trillions of bits of information, and they're inviting cyber attacks. And there's no, if consumers are not convinced that the private sector is doing a good job in protecting their data, there's no reason for us to believe the government is going to do a better job in protecting their data.
All right. Well, thank you, Mr. Quan. A centralized credit reporting agency would be a target for cyber attacks that could jeopardize sensitive information for our constituents. Additionally, hackers and criminals will use any technological advantage they can to steal sensitive information. There is no way that a government agency would be better equipped than the free market to use the latest technology and stay ahead of cyber incursions. Furthermore, putting consumer credit reporting solely in the hands of the federal government has far-reaching implications. Credit reports contain sensitive personal information, and credit scores have tangible power over our lives as consumers. I'm very concerned that creating a public consumer credit bureau would be an enormous concentration of power in the hands of the federal government. That kind of power could be mismanaged by a reactionary bureaucracy, whereas free market competition incentivizes looking forward, anticipating the needs for consumers in advance. So I agree with Ranking Member McHenry in his earlier comments, where he mentioned that competition and choice for all consumers offers the best path forward. We do not need another government takeover of an industry. That's reminiscent of a socialist-run country, not America. I know that's an agenda for many on the other side of the aisle to socialize this country. That does not work well. That's been shown. Rather, I would actually quote Ronald Reagan, who once said, "Government is not the solution to our problems. Government is the problem." And with that, I yield back.
The gentleman from New Jersey, Mr. Gottheimer, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. Each year, 15.4 million Americans are victims of credit card fraud, around 42,000 people every day. The FTC has found that 1 in 5 consumers have verified errors in their credit reports, and 1 in 20 consumers have errors so serious that they'll be denied credit or forced to pay higher interest rates. That adds up to 42 million Americans with errors in their credit and another 10 million with errors that can be life-altering. As the nation continues our economic recovery, Americans get back to work, and our lives return to normal. I think we can all agree that it's more important than ever that all Americans have access to credit. Crucial to this access is accuracy in credit reporting. Ms. Wu, one of the most common errors in credit reporting is data being mixed up between consumers. What do you believe drives these errors, and what steps should credit bureaus be taking to lower them?
Thank you for the question, Congressman. The problem with mixed files stems from matching criteria, how you match a consumer to a file at a credit bureau. We all have one unique identity. A lot of people have the same names, John Smith, Jane Doe. The unique identifier is the Social Security number, but the credit bureaus match based on 7 out of 9 digits, or they do partial name matches, or in the case of Ramirez versus Transunion that we've been talking about today, they used name only. They match based on name, and you can imagine that a lot of people have the same name, especially minority consumers. And so what you'd want to do is tighten that criteria, match based on all 9 digits of Social Security number, make sure you match on something like Social Security number or date of birth. And that's what you need to do, and that's what your bill does.
Thank you, Ms. Wu. I believe that fixing these errors is less about someone with an incorrect report receiving a monetary reward and more about actually fixing their reputation and whether the financial system views them as trustworthy or not. However, the FCRA does not give consumers the right to injunctive relief to fix errors to their credit reports. Ms. Wu, do you believe that consumers should have access to injunctive relief to remedy errors in their credit reporting file to increase accuracy? And how might we convince more stakeholders to support access to injunctive relief so consumers can fix these errors?
Absolutely, Congressman. That's an important insight. Injunctive relief is critical because at the end of the day, what consumers want is they want their credit report fixed and they want it right. And because of the Ramirez versus Transunion decision, they can't even get through the courthouse door unless they've actually, the information's hanging out there and complete strangers see it. But injunctive relief could get them the right to go through a courthouse door and ask the judge to ask the credit bureau, fix my credit report, please. Because basically, at the end of the day, that's what they want.
Thank you. You know, 1 year ago today, as you brought up in the last Congress, the House passed my bipartisan legislation, the Protecting Your Credit Score Act. This legislation would create an online portal to provide consumers with unlimited free access to their credit reports, credit scores, and credit freezes, the ability to easily dispute errors and fraud, and the ability to secure and track their data, all to boost transparency and to help Americans secure their financial health. This legislation was needed then, and it's clear it's still needed now. I just want to thank all the witnesses for being here today. I appreciate your work. I yield back.
The gentleman from Tennessee, Mr. Kustoff, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for the witnesses for appearing today. Mr. Quan, if I could with you, and I ask this in part because my district is partly rural. In 2018, the Cfpb published a report, and it was entitled "The Geography of Credit Invisibility." It examined the relationship between geographic location and credit invisibility. I'm summarizing it, but essentially the report found that rural areas have the highest proportional rate of credit invisibility compared to other geographic areas. Could you give me your opinion, Mr. Quan? What are the primary reasons for the high level of credit invisibility in rural areas?
Thank you, Congressman. I think you're absolutely right about these findings. I think it's very unfortunate people living in rural areas have challenging accessing to mainstream credit as a result. And this is really catch-22. You have to have credit in order to build credit. If you don't have credit, you cannot build credit. So how do you start? So one way the private sector comes up with is a system or a new algorithm that allow lenders to use non-traditional data sources such as rent payments, utility payments, telco payments. If that information can be used, and we have seen some early evidence that consumers' credit scores can get a boost from the addition of this new information. So if more lenders are using this new source of data, I believe this problem will be, I'm not sure it will be 100% addressed, but will be addressed.
Thank you,
Mr. Kustoff, could I address that question?
If I can, let me follow up my train of thought. If I could, Mr. Quan, and maybe you just said this, but in your written testimony, you talked about the potential of new algorithms, also known as alternative data rather, and how that could benefit customers. Do you think that the use of that alternative data can help increase credit visibility and I'm talking about specifically in rural communities?
And the answer is absolutely yes. We have seen some early evidence that the neural scoring algorithm, whether it's from Experian Boost or Ultra FICO, is exactly doing what you are hoping these new algorithms are doing. But also lenders, especially those venture-backed lenders, they are using cash flow data without even going through FICO scores to really factor into these new data sources to help increase the chances of consumers to qualify for credit.
Thank you, Mr. Quan. Mr. Ejaz, if I could to you, first of all, I want to tell you that I rely on consumer reports often for my product reviews for cars, and I cite it often, so I appreciate the work that you all do at Consumer Reports. As a general rule, under the current system, does Consumer Reports recommend credit freezes for individuals?
We recommend that consumers take advantage of credit freezes when they fear that their identity may have been stolen.
Would you recommend it, or does Consumer Reports recommend it as a general rule to people?
Yes, they should take advantage of credit freezes.
And if I could maybe follow up and take it one step further, does Consumer Reports have a position about credit freezes for minors? In other words, those under the age of 18 who may or may not have credit files. I suppose they have some profile with the credit reporting agencies.
I can get back to you in writing about specifically that part. We do recommend consumers, especially after the Equifax hack, to check their credit report and also assess their financial life. And if they fear that their identity has been stolen and people have been opening credit accounts, to take advantage of security freezes.
And taking that one step further, and this may be something else that you would need to get back, and whether Consumer Reports has any thoughts under the current system. If somebody 18 years of older wanted to get a credit freeze, there's a process through the 3 credit agencies, their websites, where they can enact a credit freeze online. That's not true for those who are minors. There are additional steps, and I'd be interested whether, again, under the current system, whether Consumer Reports has any guidance or any recommendations for parents of minors who want to try to get credit freezes. Is there an easier way to do it, or should there be an easier way to do it with the 3 agencies? And with that, I'll yield back my time. Thank you.
Thank you.
The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you very much, Mr. Chair, and thank you to all of our witnesses for lending and sharing your expertise today. In this country, our credit reports are our reputations. They determine where you can live, where you can work, and how much it will cost you to finance everything from a car to a college degree. But our credit reporting systems are fundamentally flawed. They're rife with inequities and disparities, which stifle the upward mobility of millions of workers and families. The pandemic and the economic hurt it has wrought has only further shed light on the ways in which our credit reporting systems are a flawed measure of financial health. In fact, despite the devastating financial hardship that families and communities have faced over the past year and a half, national credit score averages have increased to record highs. Ms. Wu, can you speak to this paradox and why it underscores the need for Congress to extend payment pauses and other financial protections established throughout the course of this pandemic?
Thank you, Congresswoman, for the question. It has been an interesting paradox. Despite the economic devastation of COVID-19, credit scores have not plunged, and there's several reasons for that. Number one, of course, is the stimulus and federal unemployment benefits. You give people money, they're able to pay their bills, their credit scores stay high, which shows that really credit scores are about economics and not moral responsibility, as some may put it. Another reason credit scores have held up is the protections in the CARES Act for things like forbearances, student loan pauses, and credit reporting protections when creditors do agree to accommodations. Again, these are very important, but they're about to expire. Like the eviction moratorium, they're about to expire, and millions of consumers will no longer have their protections. And so it's really important for consumers to coming out of forbearances to have the right to have loan modifications so that this doesn't hurt both their credit profile and put them at risk of foreclosure. Student loan protections are about to expire. Millions and millions of consumers are going to have to start paying that again. It's going to be a problem and a struggle, which is why student loan forgiveness is so important.
Thank you, Ms. Wu. So how much financial damage would you say we avoided then because of these protections?
I think we avoided a great deal of financial disaster, especially for low and moderate income. You know, this has been a K-shaped recovery, right? The folks on the here have done okay. It's the folks here that we need to protect. Renters, we need to protect renters because they still owe the back rent. Like the moratorium kept them from being evicted, but they owe the back rent. And eventually those show up in the form of debt collection items.
Thank you. So there's no doubt that these protections, they did help prevent many from being pushed further towards the brink. So we must act to extend these protections to ensure an equitable and just economic recovery. But we also have to work to advance bold, sweeping, and systemic reforms to our credit reporting system. Reforming our credit system is I think, an issue of both racial and economic justice, which is why I was so proud to reintroduce the Comprehensive Credit Act, a package of reforms that will overhaul the credit reporting system and provide much needed relief to workers and families across our country. Now, this bill would restrict the use of credit scores for most hiring decisions. It would ban the reporting of any debt as a result of medically necessary procedures and establish a credit rehabilitation process for private student loan borrowers facing hardship. Ms. Wu, in light of the ongoing economic challenges facing our families as a result of the pandemic, why are these reforms particularly timely?
Thank you, Congresswoman, and thank you for reintroducing the Comprehensive Credit Act. Absolutely critical and important. And the COVID-19 pandemic shows that, because it's average credit scores that have stayed afloat, but there are going to be people in that downward slope of the K that have had their credit profiles hurt. And those folks should not be shut out of jobs because of this credit damage. The time limits for this negative information should be shortened from 7 years to 4 years, which is something else your bill does. And for people who got COVID, who are left with these huge medical bills, the New York Times has documented all these patients with huge medical bills. Those medical bills should not impair their credit reports and hurt them economically for years to come.
Well, it's absolutely clear that our workers and our families can no longer afford inaction when it comes to our broken credit reporting system. Thank you, and I yield back.
The gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Well, good afternoon. I appreciate all of our witnesses being here. We've got a lot to get through, so I hope everybody can keep their answers relatively short. Ms. Wu, I've certainly appreciated many of your responses. Your passion for these issues can be seen even by a casual observer. You mentioned in your written testimony that we should, and I think I'm quoting here, restrict the use of credit reporting information in rental housing and ban it for insurance, end quote. I wondered if you might expand on that. I know that's not your main point of your testimony, but certainly that sentence stuck out to me. Do you think that credit report information for insurance is not predictive, or why would we want to ban that?
Thank you for the question. The use of credit scores in insurance is just simply illogical. What does your credit record have to do with your driving record? There's just really no causation. Now, there's a correlation, but correlation does not make causation. And we also know, as the other witnesses have pointed out, that there are massive racial disparities in credit scores. So the use of credit scores in insurance also results in Black and brown drivers having to pay a lot more for insurance.
So, Ms. Wu, is it your assertion that credit reporting has no predictive power and is simply a proxy for race? Because an abundance of research indicates the exact opposite of that. And I would imagine these insurance companies are interested in getting the most predictive power possible for the risk that they are taking. They're not including these just by virtue of being proxies for race, but instead because they're valuable indicators in potential risk going forward.
Again, it's about correlation. People with impaired credit, for example, their finances may be more constrained, so they may be filing claims more often. People with more resources, maybe if they get into a fender bender, they don't put in a claim because they can pay a few $100s out of pocket. But people with more constraints on their finances, who may have lower credit scores, may need to file a claim because they can't afford to do that. It's correlation.
So, Mrs. Wu, So, Mrs. Wu, I guess just to summarize there, because I'm just trying to understand the argument, your statement is that they may cost the insurance company more, but the insurance company should be prohibited from underwriting the potential risk that they're going to have higher payouts on account of writing that policy?
The way insurance works is consumers should be able to file claims when they have an accident.
For sure,
And
no one does
so
that.
they shouldn't be penalized and there's also this idea that credit is supposed to be some measure of moral responsibility. We know from the pandemic that's not true.
Yeah, Ms. Wooten, I did not say that. I have never said that. Just for clarity, I absolutely agree with you. People should be able to file claims, but I disagree with the notion that somehow the potential loss for the insurer should not be a part of the risk that they are underwriting in doing that policy. Correct or incorrect? If they're going to be higher claims in the future, for whatever motive or reason there may be, they should be able to charge more for the premium for writing that particular insurance. That's how insurance works.
But these are folks that haven't filed the claim yet. What, you know, I mean, if by that logic, the insurance should be rated on income because people who have less income might be more likely to file claims.
Well, for clarity, that's why it has predictive power, right? Because they're trying to predict what their potential losses might be and thus match the risk with the price that they are charging. The FTC and Georgetown University have done their own research into this and found that credit scores actually are predictive and not a proxy for race, as I mentioned. I know that a lot of this hearing and other hearings have mentioned the University of Michigan study, which is entitled Auto Insurance and Economic Mobility in Michigan, A Cycle of Poverty, and have used that as a rationale for banning credit score data in auto insurance underwriting. Frequently, what is referred to as Detroit being at a much higher cost to insure cars than other states. However, all of the other states that are compared also use credit scoring. So there's nothing unique about the use of credit scores in Michigan versus other states that would lead us to believe that that is the problem in Michigan where insurance costs are much higher. Instead, what study after study has found is that it is predictive in the potential loss for insurance, and insurance companies are charging for the risk that they are taking. And in taking more risk, they have to charge more. And with that, I'll yield back my time.
The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Mr. Chair. In Transunion versus Ramirez, the Supreme Court, in an act of judicial usurpation, held that the courts, rather than Congress, ought to decide which legal rights are enforceable in federal court and which harms are concrete enough to establish Article 3 standing. My first question is for Ms. Wu. To what extent does the court's recent decision in Transunion versus Ramirez undermine the enforceability of the Fair Credit Reporting Act?
Thank you for the question, Congressman. The Supreme Court's decision in Ramirez versus TransUnion really undermines the ability of consumers to seek redress in court for credit reporting errors. It basically says that the fact that there's an error, no matter how bad, and being accused of being a terrorist is a pretty bad error, you can't go to court unless a creditor or an employer or someone else has actually seen it and your reputation's already been besmirched by the error.
And what can and should Congress do to strengthen the Fair Credit Reporting Act in light of the Supreme Court's decision weakening it?
So Congress can and should act to address Ramirez by passing a right to seek injunctive relief under the Fair Credit Reporting Act. Even though the Ramirez decision rested on constitutional grounds, it left open that possibility that if you're asking a court for injunctive relief, you may be able to show standing because you're trying to prevent the risk of harm of having a credit report with this terrible error in it being shown to third parties.
Now, I'm one of 4 representatives of the Bronx, where 30% of residents have no credit history. I have constituents who have been paying their bills in full and on time for decades, constituents who have shown themselves to be objectively creditworthy. But none of that is captured in traditional credit scoring models. If we had credit scoring models that consistently captured alternative data, do we have a sense of how much more of the population would have a credit history and a credit score? This question is for the witness from Consumer Reports.
I am not aware of what that difference would be. I'm happy to look into it and follow up in writing. But it is definitely a significant issue.
And Ms. Wu, I know the National Consumer Law Center has concerns that alternative data, if applied improperly, can do more harm than good. Can you share your thoughts on how to harness the power of alternative data to produce greater access to credit without doing more harm than good?
Yes, thank you, Congressman. It depends on what data you're using and how it's used. So rental data, as you pointed out, can be helpful, can be promising, as long as there's consumer choice. Again, consumer choice is key because there's 10 million Americans who are behind on their rent. They don't want their information. They may not want their rental information put into the system, but tenants who have been paying regularly on time and don't have that concern should be able to opt in. We do have concerns about gas and electric utility payment data because, I'm from Massachusetts, you're from the Bronx, those winter bills can get pretty high and people can get 30, 60 days behind. So that could hurt. But again, consumers can have the choice if they want to opt in because they don't have those negative marks. They should be able to opt into the system. So it's always about consumer choice, as well as, having alternative scores that are sort of second chance instead of feeding the information into the credit bureaus wholesale where it might hurt some people.
And in addition to an opt-in requirement, could there be a requirement that only favorable alternative data be reported? Because obviously a bad credit history would be worse than none at all.
Yes, a positive data certainly would be helpful. And, as some of the other speakers have pointed, witnesses have pointed out, the negative data shows up in the form of debt collection items already. So mandating the positive data would be helpful and would balance that out.
And what do you think is the single most important thing we can do in Congress to ensure that everyone has a credit score and a credit history?
I think giving consumers the choice to have it included would be the single most important thing.
I see my time has expired. Thank you.
Does the gentleman yield back?
I yield back. I surrender.
The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thank you to the witnesses for their testimony. First off, let me start by saying I think we do need to more critically look throughout our committee about how to expand access to credit and banking services. Without each, it is difficult for low-income Americans to achieve financial success. I've said that, I think, since really one of our first hearings last Congress when we had the agencies here. And I do think that we need more innovation, we need more competition, and we need a healthier credit space for sure. That said, the bill that we're being asked to consider, I'm hard pressed to find a worse idea, frankly, than to federalize and ultimately socialize credit reporting in this country. Unfortunately, it's sort of part and parcel for how our friends on the other side of the aisle like to solve a lot of pressing issues, which is if you don't like what's happening, just have the federal government take it over and see what happens. Well, we know that doesn't typically work very well. It's less secure, far less innovation, and ultimately, I would argue, would lead to worse outcomes economically. But, we'll ask Mr. Quan for his thought on some of those things. So, Mr. Quan, what sort of impact do you believe creating a federal reporting agency would have on innovation and investments into new technology by the private sector to promote access to credit?
Thank you, Congressman, for the question. So you already hit the nail on the head. So when the government gets involved, the new credit bureau backed by the government will be backed by unlimited taxpayer revenue. So the private sector cannot compete. As a result, innovation will disappear naturally. And we all know this is, economics 101. Government involvement will crowd out private investments. And all the innovations we're seeing today, the innovations I've mentioned, whether it's, ultra FICO score or experience boost or the cash flow based underwriting, will disappear. And there's no evidence the government is doing a better job or can do a better job in adopting or developing new technologies to improve access to credit.
Thank you. Couldn't agree more. Based on the conversations that I've had with my constituents, customer service across the different federal agencies isn't necessarily a strong suit of the federal government. I think today, right now, for example, those who are waiting for passports are completely out of luck because of the backlog. We've been solving passport issues for a long time, and this is the worst that our office has ever seen it. That's just passports. But what is your assessment of the ability of the federal government to operate a credit reporting agency and the likely customer service implications for such a project?
Well, so again, you have already given a very good example using passports. So the Cfpb is consumer complaints portal. I think we mentioned some. I think the witnesses have mentioned in the tune of 300 to 400,000 consumer complaints related to credit reporting. But in reality, the CRAs receive far more than that. They receive millions, not just complaints, but disputes. There's no reason for me to believe the government, which has no expertise or any kind of experience to handle the kind of complaints volume, what we're going to end up having is a system that's probably going to be worse than what we have already now.
So less innovation, less competition, worse service. Sounds great, guys. I'm really, really excited about this bill. Final question. In your testimony, you mentioned concern over future data breaches at the credit reporting bureaus. I agree. We've seen that in a lot of different sectors of the economy. There's no reason to believe that this isn't going to continue, unfortunately. In your estimation, what more should Congress be doing to prevent another significant breach of a credit bureau?
So I believe that credit bureaus should be held to the same standard that financial institutions. So for example, if you are a critical service provider to financial institutions, you are examined by the prudential agencies under the Bank Service Company Act. We should have a similar regime that applies to the credit bureaus. So I'm not saying having federal supervision will permanently fix the cybersecurity issue. The cyber risk will always be there, but without appropriate federal supervision, I'm just not confident that consumers will feel sure that data is secured by private sector bureaus.
Thank you. I see my time is up, and I yield back.
The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Mr. Chair, and I thank our witnesses for your important information today. I'd like to follow up on Mr. Scott's questioning earlier during this hearing about student loan debt, particularly private student loan debt. Many borrowers remain trapped in abusive or predatory lending arrangements, and credit agencies still view this as bad debt, hurting the future economic horizons for these borrowers. I'm a former professor, so I care an awful lot about student debt. Ms. Wu, in your testimony, you speak about consumers being unfairly penalized in their credit reports when they are victims of student loan abuses. Can you describe that situation more specifically to us, provide us an example, and how that has long-term consequences?
Thank you for the question, Congresswoman. So private student loan debt is certainly a problem, and it is a problem that affects Black and brown borrowers disproportionately. Unfortunately, it's also tied to the issue of for-profit schools and other institutions that take advantage of Black and brown students, promise them the sun and the moon, give them substandard educations, and then saddle them with private student loan debts, which ends up on their credit reports, maybe as defaults and delinquencies, or just a lot of unmanageable debt. And unfortunately, the student loan pause from the CARES Act also didn't help private student loan borrowers. The Comprehensive Credit Act does have some provisions to help with private student loan debt in terms of rehabilitating those, but certainly the credit reporting consequences are only one part of that.
That is what I was going to follow up with. Ms. Wu, we know that during COVID-19, the pandemic, many private student loan borrowers did not get any relief. So I do lift up Ms. Presley's, the Comprehensive Credit Act. Could you describe how the lack of that economic relief, has impacted private student loan borrowers?
So unlike borrowers for federal student loans, they've had to keep paying those. Federal student loan borrowers have had a pause and suspension of their obligations. So those private student loan borrowers that may have suffered economically during the COVID-19 pandemic either still had to pay their loans or would have negative items on their credit reports from not being able to pay because of the economic fallout of COVID-19. And so this could follow them for another 7 years.
Exactly. It's such an obvious inequity. We treat one set of student borrowers one way and another set in an economic collapse another way. Ms. Traub, I'm going to try to fit in a question, if I may, with you. I appreciate your testimony that credit reporting is part of infrastructure. It is a resource needed to fully participate in society. And while credit reporting does not take race into account, can you describe how systemic racial inequities fail to allow equitable access in this essential infrastructure? Could you give us a little more on that topic that you offered us in your testimony?
Thank you, Congresswoman. We can look at where credit discrimination comes from, because you're right that credit scores and credit reports never explicitly and directly take race into account. But we know that for decades we had economic policies in this country that enabled white families to build wealth, but excluded Black and brown families. Wealth is passed down over generations, and access to that generational wealth shapes our behavior. It shapes people's borrowing and payment behavior today. And so people without access to generational wealth need to borrow more to go to college, to buy a home, sometimes just to make ends meet. And then there's also ongoing discrimination. So it's not a surprise, really, that we see racial disparities turn up in credit reports. And I want to be clear that we need to fix a lot more than credit reporting to achieve racial equity. But fixing credit reporting, I believe, would improve one system that spreads inequality every time that it's used.
I appreciate that. Would anybody else like to speak to that issue of systemic racism in the credit reporting system, as we say, not explicitly, but implicitly?
Yes, thanks for that. And I'd just like to emphasize the point that she made, that there are systemic and historical barriers that have been baked into our current lending systems and our lending structures. And it was referenced earlier, things like redlining that have held credit away from Black and brown communities. And and I guess this is another term we've been using a lot today, naive to believe that that is not making its way into our credit reporting system.
Gentlewoman's time has expired.
Thank you. I yield back.
The gentleman from Wisconsin, Mr. Stila, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. Some of my colleagues today have argued for the removal of predictive information from credit reports. I see this as really an attack on risk-based pricing, in which lenders attempt to assess the creditworthiness of a prospective borrower and adjust prices to compensate for that risk. Risk-based pricing is a foundational concept in our financial system, and undermining the practice will increase the level of risk across the financial system and reduce credit access. Mr. Quan, if I can ask you, would you agree that making it harder for lenders to assess risk will effectively socialize that risk? And then how would that impact lower income and marginal borrowers specifically?
Thank you, Congressman, for the question. So I have repeatedly said that we need accurate and complete information in consumers' credit files. Accurate means whether the information is positive or negative, the information should be there. So if we remove or if we intentionally suppress negative information, on surface, it helps consumers who have negative information. But by and large, lenders will not have the best information available when they make decisions to credit.
So let me dive in, because I think we've hit the point a handful of times here today. But let me shift gears ever so slightly for you, Mr. Quan, if I can. People with low credit scores, thin credit files, young people, recent immigrants, members of underserved communities can all benefit from improved access to credit. And unfortunately, I think much of today's hearing is focused on ways to weaken the credit scores and obscure risk. When, to me, these ideas would increase costs and reduce access, especially for today's underserved borrowers. And so hollowing out credit reports won't help a single mom in Janesville, Wisconsin get a mortgage. It won't help a family business in Racine, Wisconsin get a small business loan. So instead of excluding data from credit reports, should we look at ways to include more predictive data that may help bring more Americans into the financial services system? And so, Mr. Quan, if I can, let me put a pin on it here. My colleagues on the other side of the aisle have argued that we need to get a government-run credit bureau to come up with new algorithms to address credit access. Do you agree with the assertion, or is the private sector unwilling or unable to specifically innovate in this area? Could you comment?
Well, Congressman, you're absolutely right. So the private sector has already come up with new algorithms, the so-called new. There's nothing new there. It's been around for a number of years now. And frankly, this innovation is happening just mainly because of, number one, there are mission-driven companies that are trying to solve the problem. But number two, more importantly, this is a capitalistic society. There's a profit motive behind it. This is the market that's unaddressed. Now it's being addressed by innovation, and lenders can make money, and then also they can fulfill their social mission. So the government.
Mr. Quan, if I can, these hybrid hearings are challenging. I look forward to all of us being in person. But if I can, and appreciate you being here. I think you hit the nail on the head. The private sector's looking at this. Let's dive in and let's do some concrete example. Experian Boost, Ultra FICO, some of these opt-in alternatives. Have these models in businesses expanded and improved credit access for individuals, in particular, some of those that are currently underserved?
The answer is absolutely yes. So we're still in the very early stage, right? So Experian Boost has boosted 69 million points FICO, and this is not Vantage score. This is the FICO score. This is especially FICO 8.0, which is the score that most lenders use today. So there is a clear evidence that this innovation is driving access to credit, to expand access to credit. So the low-income consumers, the people of the new immigrants, people like me who wouldn't be able to get access to credit early in my days in the United States, now we have a chance to get credit.
I appreciate that. So let me just sum it up like this. So one of my takeaways from today's hearing is that credit reporting can be easily politicized. And with that in mind, I'm concerned about proposals to centralize credit reporting in a government-run agency. I'm not sure my colleagues have fully considered the implications of providing a government agency with even more of our personal financial information and then granting that agency the power to effectively withhold access to credit. A government-run system raises the prospect of politicized credit access decisions, a loss of financial privacy, and heightened cybersecurity risk. Many Americans don't want the government to exercise this power, especially if it's based on what they buy and which bills they prioritize. Our credit reporting agencies are not perfect, but American consumers stand to benefit far more if we improve our existing competitive private sector system than if we centralize the financial data at a government bureaucracy. I urge my colleagues to reject the proposal, and I yield back.
The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Chairman. I so appreciate this hearing because credit scoring has been something that impacts my community directly as is the third poorest congressional district in the country. You know, Mr. Greer, would you agree that racism is profitable? So I would like,
Yes.
Mr. Chair, thank you. I would like to submit for the record, Mr. Chair, a great op-ed from Rashad Robinson that says corporations profit off of racism into the record, if I may.
Without objection.
Thank you. Mr. Greer, you talk about oppression economy in your testimony, and I think that's really powerful because what we're hearing is words that corporations use, risk-based pricing, assessments, as we all continue to hear these kinds of really interesting terminologies. But I can tell you personally, auto insurance, for instance, rates in my state is the highest in the nation. People will say it's all these other different factors, but credit scores are actually used to calculate people's whether or not they're a safe driver. Credit scores. So when we talk about structural racism and talk about this hearing, we have to really talk about the human impact of what this means, right? They're selling our data, the credit scoring agencies for profit, to auto insurance agencies that are using non-driving factors as proxies, marriage, whether or not you're married, whether or not your education level, all these things, again, has nothing to do whether or not you are a safe driver. But they'll use words like risk-based pricing or assessments. So, Mr. Greer, I mean, when you think about those kinds of measures of using these as proxies, and I'm talking specifically about the auto insurance industry,
Right.
the use of credit scores, how has that really impacted communities of color?
Right. So what this, I'm really thankful for all the work that you do, Ms. Salib, not just for the people in your district, but the people of color across the country. But this idea is to create a class of people who can be exploited, who can have their auto insurance be much larger than it would be in another part of the country, or if they're another type of person. So the reason why and I think this has been documented, that auto insurance is higher in your community is because it's largely Black, Latino, and Arab American people that are living in your community. And that because our economy has been built on a system that exploits racism as a way to draw profits, this is how that plays out in that sector.
Mr. Ejaz, do you know what credit scoring has to do with driving records?
It has nothing to do with driving record. Credit scores and reports, in my view, should only be used to assess creditworthiness, and as a general rule, should not be expanded beyond that.
Ms. Traub, it's interesting. When somebody's credit score is lower and they use it towards calculating their auto insurance, do you know their auto insurance rates actually goes higher? So if you're poor, you're paying higher rates, even though you're a safer driver. Did you know, Ms. Traub, that if you had a DUI, but a better credit score, you were paying less than an auto insurance than somebody that has no DUI record, but a lower credit score? Did you know that?
That's correct, Congresswoman, and it's terribly unfair.
That's a form of structural racism. If you look at who's impacted, it is communities that are low income. So I want to get to our next thing, which is medical debt. Ms. Wu, you know how passionate I am. I don't want medical debt to be used similar to as if you bought a car and you missed a payment. This is basically, you're sick, you have to get, this is medically necessary debt, and it ends up on your credit report for years. Given the credit reporting agency's poor track record, what kinds of things that your organization is doing to expose the fact that medical debt in our credit reports actually impacts or expands economic disparities in communities like mine?
Thank you, Congresswoman. Thank you for your passion on this particular topic. The proposal you had that medically necessary debt should not show up on credit reports is one of the most important aspects of the Comprehensive Credit Act. The CFPB has found over half, it's up to 58% of debt collection items, third-party debt collection items on credit reports is for medical debt. It's a massive amount. And, COVID-19 really exposes how not only this is just a terrible, unjust problem, but it's also runs along racial lines, because we know Black and Brown Americans have suffered under COVID-19 more. And New York Times has documented how COVID-19 has resulted in these huge medical bills for some of the patients. And then this stuff ends up on their credit reports. It's wrong. It's just wrong.
Mr. Chair, if I may, we are pushing for legislation, hopefully you all can take a look at it, of reducing markings on credit report from 7 to 4 years. I know it's a good compromise. Of course, I don't want the credit reports being used, but I think moving it from 7 to 4 years can dramatically really help our communities. But right now, I think this hearing was critically important to expose at least.
The gentlewoman's time has expired.
Yeah. Thank you.
The gentleman from South Carolina, Mr. Timmons, is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm opposed to the chairman's bill to create a public credit registry and believe it's a big government solution in search of a problem. Mr. Quan, picking up where my friend from Wisconsin, Mr. Stiles, just left off, risk-based pricing helps to make credit affordable for all. As our economy is recovering from the pandemic, do you believe transitioning away from risk-based pricing would help consumers?
So think about what happened 10 years ago, the last financial crisis this country experienced. Lenders ignore risks. They lend money to people who couldn't afford. That's because of lack of risk-based pricing that caused the last financial crisis. So risk-based pricing is very critical to have today. as we recover from this pandemic.
Sure, thank you for that. As a follow-up, could you discuss the impact that suppressing or keeping negative information out of credit reports has on the safety and soundness of our financial system?
So lenders need accurate information and complete information to make lending decisions. If we intentionally suppress accurate but negative information from consumers' credit files, lenders will not be able to make the best decision they can. As a result, there will be an increase in defaults. And as a result, we have an unsafe and unsecure financial system.
And that would likely result in everyone's premiums going up for the insurance they're currently paying for. Is that correct?
Absolutely. Everyone's price will go up as a result.
Okay, thank you. Moving on, I know cybersecurity has been a popular topic of conversation today, but I'd be remiss if I did not chime in as well, especially given that today we received news of another massive breach, this time at LinkedIn. We have seen several government agencies hacked in the past, putting Americans' data in the hands of cyber criminals as well. Creating a one-stop shop of consumer credit information in a brand new federal agency that has no experience in this particular area is just asking for trouble. We've seen Congress has also had challenges as well. Mr. Quan, what level of risk to the average consumer would the PCR, as proposed by the majority, pose to the American people?
Well, the risk will be unthinkable because all of a sudden, all the information is concentrated and centralized by one government agency, which has no experience, no expertise in safeguarding that information. And as you mentioned, there are so many government agency breaches. And my data, when I was working for the government, was breached because of the OPM data breach. So there's no evidence the government is able to do a better job than the private sector in safeguarding our information.
Sure, but I would imagine suing the federal government and getting, a few $1 trillion for the breach to the parties that had their data breached would be a good solution. Since
that would be
so much money to give away.
Well, Congressman, absolutely agree with it. So look at the Equifax settlement, $575 million up to $700 million. But who's gonna pay for it? Shareholders. So if you're investing in Equifax, bad luck. But if the government was responsible for that, $700 million, that's how much TARP was originally for. So of course, today we are handing out trillions of dollars. $700 million maybe sounding like a drop in the bucket, but still, that's taxpayers' money.
I have a feeling that the government would settle for far more than the Equifax breach. So, bad idea. Thank you. Mr. Chairman, I yield back.
This committee is going to adjourn in order to make votes. Unfortunately, that means we'll have to curtail questions. I'd like to thank our distinguished witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.